The question of IRS hiring, IRS firing is a bit of a medium-term question as to what happens going forward with taxpayer service, with guidance, with enforcement, not this year, but in years to come.
Talked to the Deputy Treasury Secretary on Friday on Bloomberg TV, Erica, who pointed to the receipts, the actual facts here. Gross U.S. budget receipts for the fiscal year up 3%. This is through March, to $2.26 trillion, according to the Treasury. Michael Faulkender says that's a robust tax filing season. Could that, in fact, be the story?
It very well could be. And if we look at the tax gap over time and we look at how the U.S. compares to other countries, we're not like a major outlier. Most people pay their taxes. Most people pay them on time. Our tax gap averages about 15%. That's the difference between what the IRS estimates should be paid and what ultimately is paid after audits and follow-ups. And that's tended to be pretty steady. So I don't think we'll see, sudden overnight huge drops, but it may be something that plays out over time. Probably not this year, though.
Well, and this year, of course, we are facing down a kind of clock here with the debt ceiling that still needs to be raised by Congress. The Congressional Budget Office, Erica, obviously has suggested they think the X date will come sometime in August or September. But just how easily could that be moved up, knowing there's only so far the Treasury's extraordinary measures are able to go?
Yeah, that could be subject to change, especially as we see timing delays with tax payments related to natural disasters. So several states have extended periods for when they actually have to pay taxes, and some of those go out past that estimated X date into November. So you could see timing issues there where it's not that the taxes aren't being paid, it's just they're delayed because we also have this natural disaster tax relief that we provide through the tax code. So that could be one factor to watch and see how that could potentially move up the X date.
We've talked a lot about a wealth tax, Erica York, over the years. Now we've apparently narrowed this down to a millionaire's tax. It's being discussed by Republicans on Capitol Hill and the White House. Our political team reporting that Donald Trump is actively considering these ideas. The House proposal specifically would set the new rate at 40% for taxpayers earning $1 million or more a year. What kind of impact would that have?
Well, that wouldn't be a huge tax increase relative to where that tax rate is scheduled to go. Recall that after the end of this year, the top tax rate is scheduled to rise already from 37% to 39.6%. So going to 40% isn't a massive change from there. What it is a massive change from, though, is the way we typically hear Republican lawmakers talk about tax cuts, which is lowering those top marginal rates so we boost incentives to invest and to work in the economy. Much better ways to raise revenue exist than raising marginal tax rates on work and investment. Things like broadening the tax base, clamping down on itemized deductions, looking at types of income that just aren't subject to tax at all would be much more fruitful than something like raising the top rate even higher.
Okay, so if this is really just a marginal potential increase in the top rate, how far would it realistically go to offset other initiatives we understand Republicans are pursuing, like, for example, raising the cap on the SALT deduction or no tax on tips or overtime, programs that we understand could add materially to the total cost of this bill?
So it really depends how they design those other types of tax cuts. The full proposals that Trump campaigned on would add, $2 to $3 trillion to that cost when we look at no tax on Social Security, no tax on tips, no tax on overtime. Depending how lawmakers design those, though, they could tailor them. They could put income limitations, they could put total limitations on the amount of the tax benefit available and really narrow down the cost. So then you wouldn't have to look too hard to find an offset. And really, that's the kind of stuff I wish we would be seeing from Congress already. But so far, we're close to 100 days into this administration, into this Congress. We've really seen the debate center around procedure and politics and not even delve into policy yet. So those are questions Congress needs to answer and needs to answer quickly because the deadlines are coming for decisions on what to do on the tax bill, decisions on what to do as far as the debt ceiling goes, and all of that is wrapped up into one legislative vehicle right now.
Talk to us about enforcement, Erica. A big part of the narrative today, whether it's true or not, is that tax cheaters will have an easier time, and maybe some taxpayers will become cheaters because it's getting easier to pull a fast one on the agency. Is that real or not?
Potentially, we don't really know. I would say one of the best ways to raise tax revenue is to raise the revenue that should be paid right now. So rather than lifting rates, rather than creating new types of taxes, making sure that people pay the taxes that is due is a really good way to raise revenue. We don't really know how this firing at the IRS, this workforce reduction is going to play out. But I would say one of the things that it threatens is what you just said. People lose faith in the system. People distrust that their neighbors are paying their taxes, so why should I pay mine? That's not the type of vibe we want to create around taxes. We want trust in the system. We want transparency in the system. And really large workforce reductions without complementary simplifications to the tax system don't go in the right direction. You shouldn't significantly reduce the IRS workforce if you're still maintaining a really complicated tax code that has all different kinds of programs run through it. The first step should be dramatically simplify the tax system so there are less opportunities for abuse, and then you can shrink the workforce along with that simplification in the tax code.
And finally, Erica, what factor will tariffs ultimately play in the overall revenue picture, knowing that while the higher reciprocal rates are paused for 90 days, there is that 10% global baseline, 145% now effectively on Chinese imports, autos, steel, and aluminum. What's the net effect of all of that?
Right now, we've estimated that it will raise somewhere in the ballpark of $150 billion to $170 billion this year in 2025. That is highly uncertain. It's uncertain because the tariffs are really on again, off again. You only get revenue if they're on. If they go off again, you don't get that revenue. They're also subject to other types of uncertainty, like if Congress decides to challenge the president's authority, if those authorities get challenged in court. And are struck down. That could be another reason that revenue goes away. But ultimately, even with all of the tariffs that the Trump administration has outlined so far, it doesn't come close to paying for even extension of the Tax Cuts and Jobs Act, not to mention all of the other tax cuts they want to add on top. So right now, falls short of paying for tax reform, is highly uncertain, and is very economically harmful. So isn't even a good way to try to offset the cost of tax cuts, because you're probably harming the economy more with a trade war than you're helping it with the tax bill Congress is considering.
It's like a holiday for you, Erica. Is this Christmas morning at the Tax Foundation?
I need a holiday after this day.
I bet you do. I appreciate your joining us on what must be the busiest day in your world. Erica York, the Tax Foundation, where she is Vice President of Federal Tax Policy. He's not going to be talking about the IRS when he's speaking nationally in Chicago later on, Kaylee, but another agency that we've been talking about today, and that is Social Security, the return of Joe Biden, something we'll be talking about later on.
Yeah, he's going to be speaking around the time of the late edition of Balance of Power, his first big speech since leaving office back in January. I guess the question is, while Democrats may like his message, are they happy with him as the messenger?
That's true. We'll find out together. That's around 5 p.m. We'll be watching. Our panel's next on Bloomberg.
It's 121 on Wall Street. I'm Amy Morris, and stocks are showing some volatility again amid some headlines on President Trump's tariff war with top trade partners. The S&P 500 initially was rising today, then wiped out gains. We do check markets for you all day long here at Bloomberg. The S&P 500 is now down 2.8 points. NASDAQ is down 21 points, and the Dow is down 34 points. The S&P, NASDAQ, and Dow all down less than 0.1%, but still, they're lower now. The 10-year Treasury yield at 4.3% and the 2-year yield at 3.81%. The European Union and U.S. have made little progress in bridging those trade differences. U.S. officials indicating that most U.S. tariffs on the EU will not be removed. The EU has offered to remove all tariffs on industrial goods, including cars. The U.S. rejected that, instead suggesting some tariffs be offset by increasing investments in exports. The EU has agreed to delay implementing counter tariffs against the U.S. for about 90 days, but will impose them if those negotiations don't pan out. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy Morris, thank you so much. This is Balance of Power, the early edition, just after 1:20 p.m. Eastern time here in Washington. It was roughly around this time yesterday, actually, that we got news from Harvard University, which, through the lawyers it's working with, rejected a proposal from the Trump administration, which had threatened to revoke up to $9 billion in federal funding if the Harvard administration didn't acquiesce to what the Trump administration would like to see when it comes to DEI, hiring practices, admissions practices, anti-Semitism efforts as well. And we learned last night how quick the White House was to react to that, with $2.2 billion in federal funding now pulled. And the president today, Joe, threatening to take things even further.
Along with a $60 million contract. This is pretty remarkable and maybe not much of a surprise to those who have been following this story. Some of the reporting had suggested that Donald Trump would like to see this happen to any number of Ivy League schools. It's something we've talked to our panel about quite a bit, and they're with us now. Rick Davis, partner at Stone Court Capital, a Republican strategist, alongside Jeannie Shanzano, Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. Did this need to happen, Rick? I think it's something that you saw coming.
Yeah, look, I mean, this administration has been after what they call woke universities. They see it as a core culture issue in their agenda. And they're going after these universities, both public and private, under the guise of attacking the university's acquiescence to anti-Semitism, which I think they think is universally acceptable. But they're really, in essence, trying to gut the DEI programs and other more liberal efforts on these university parts in their curriculum and in their personnel. So it's a pretty significant war on education. And right now, I would say Harvard has at least struck out to be one of the institutions, one of the few institutions to really decide to pick a fight with the federal government.
Well, and we're seeing what the consequences of that fight may turn out to be. Again, Jeannie, $2.2 billion of multi-year grants frozen as a consequence of this, with the president today on True Social suggesting that Harvard's tax-exempt status may need to be looked at as well. You obviously exist in the higher education universe. Can you just describe for us what the actual consequence of that will be for Harvard, for the research that is done at Harvard, in addition to just its educational mission?
Yeah, I mean, ultimately, there would be a chilling effect. I mean, we can't forget Harvard gets $9 billion, which is a staggering amount from the federal government, and they are the wealthiest university in the country, if not the world. They have a lot of resources. Unlike many universities, they have a huge endowment. So they can take this fight to the administration. The problem is, if Harvard doesn't, nobody else can do it. And so, you know, there are implications for higher ed across the board. But the reality is that we are either a nation of laws or a nation of one man. If we are a nation of laws, you follow processes and procedures. You follow the law. And that's the problem here. There is a law in place, Title VI. it lays out that federal government can give funding to these universities, public and private, provided they're not discriminating. So the anti-Semitic portion of this is exactly right on the part of the administration. The problem is they have gone overboard if you look at their demands on on Harvard and other universities, where they are trying to decrease freedoms, academic freedom, freedom of speech, cancel DEI programs, curriculum, and the rest. And that is outlawed in this law. So if Donald Trump wants to take this fight on, he needs to do something he doesn't want to do. Follow proper procedures, go to Congress, get Title VI rewritten, and pass that law with Congress, and then you have the law behind you. But as it stands now, he does not have that behind him. And that is the root of the problem with everything we're seeing in this administration. He doesn't want to follow procedures. He wants to follow Donald Trump's whims.
Rick, I know Harvard called this illegal activity, but was there a better way for the university to handle this? Maybe acknowledge some of the points that the White House was asking for, maybe, categorize them differently than the others. There was specifically a request for the university to report foreign students who commit conduct violations to federal authorities. Is there something here that Harvard could have done differently?
Yeah, sure. I mean, there are always things these universities can do to fit into this concept that the Trump administration is promoting. And other universities similar to Harvard, Columbia, and others have basically worked out arrangements with the Trump administration to continue to get federal grants and federal aid, by adjusting some of their criteria as to how they run their universities. And I don't think there's any doubt that there are questions that have been raised as to how these, especially these Ivy League universities, conducted themselves, how they were managed, how they made decisions, who they hired, were major issues in the summer of last year when you had basically riots on these campuses promoted by agitators in advance of the Palestinian issues. And I think that it opened the door to this kind of criticism. But there are some people who think Columbia did the right thing by working on a deal, maintaining their financial support by the federal government, and at the end of the day probably did not lose the construct of who Columbia is, what they teach, and how they act. So there are universities that are taking a different route, and it's kind of hard to decide right now whether or not Harvard's taken the right approach or Columbia took the right approach.
Well, and I guess that raises the question, Jeannie, if you expect more higher educational institutions to follow Harvard's path or Columbia's?
It's a really difficult choice because most universities do not have the resources that Harvard has. And you see the two conservative lawyers they have hired, well respected, one of whom Representative Steve Bannon and many of Donald Trump's friends. So Harvard knows how to fight this fight. But the reality is Columbia is in a problem because when you capitulate to this type of illegal and bullying behavior, then you are left with the kind of chaos that Columbia has been left with at the top of its board. And so Donald Trump can do this and Congress can do this, but you've got to do it properly. It is funding by Congress. They need to change the title. They need to change the legislation. And then Donald Trump needs to follow proper procedures. But we can't live in a country where you give a grant, which is like signing a contract, and then because somebody new comes into the presidency, pull that back if they don't meet demands. Republicans would not like it if Joe Biden or the next Democratic president does it, and Democrats don't like it. So the reality is you've got to be agnostic. We are a country of laws. Follow those laws. And it's particularly important when it comes from the president. And it's sort of a running theme throughout everything we've been talking about, is a president not want to follow procedures, but his own whims and interests. And that is not workable in the United States if we're going to maintain a rule of law society.
Rick, you know that Harvard is an easy target. And as somebody who used to live right across the river in Boston, it receives criticism nowhere more than in its own backyard. Is this good politics in the end for Donald Trump?
I think it's probably good politics for Donald Trump. I mean, every day that he gets to go out and say, that Harvard was receiving $9 billion of taxpayer assistance when they have an endowment of over $50 billion. Doesn't make sense to most voters. Why in the world would we give federal dollars, our taxpayer dollars, our money as voters to a private university named Harvard, which is beyond exclusive and out of the reach of virtually every American citizen across the board? It's a select few that get the benefit of a Harvard education. And so I think on the surface, it is a very difficult issue for Democrats to claim foul because, once again, they'd be out there pitching for the, liberal Northeast Ivy League institutions, by the way, well represented in the Trump cabinet and White House. I mean, there are a lot of Harvard grads in Congress and in the White House. And so, but you don't hear any of them stepping forward and complaining about this. So how much of this is legal? How much of it is policy? I think is the debate that we're into now. But the optics for Republicans, they can fight with Harvard all day long, and they're not going to lose any votes, and they may pick up a few as they go along.
Jeannie, I want to return to the point you were making about this president in particular not necessarily being the most in keeping with procedure or with the existing legal system as we know it, because that is what will be in focus today. As there's another hearing in the Kilmer Obrego Garcia case, of course, the El Salvadorian who was deported to El Salvador, which the administration admitted was accidental. We all watched in the Oval Office yesterday when both the Trump administration and the president of El Salvador said neither of them have the power to return him back to the U.S., even though the Supreme Court has said that must be facilitated. Do you see this ultimately ending in potentially contempt of court proceedings for these officials that to this point have been largely stonewalling the judge overseeing this case?
Yeah, I don't know if we're going to see that, because part of the problem is the Supreme Court left a hole that the administration could drive a truck through. Facilitate as a return, but explain to us what you mean by effectuate. And oh, by the way, defer to the White House on foreign policy. And we've seen Stephen Miller, the president, and others take wild advantage of that. And so I don't know that it's going to end in contempt. We may see some of that. But I think the reality is it is disingenuous for both Bukele and Donald Trump to sit there and say we can't return this individual. And by the way, if he's returned, they can deport him legally following the laws within hours. But it's disingenuous for them to make that argument, considering we saw them already return 9 people. And so once again, Donald Trump does not want to follow proper procedures. You messed up, admit it, send him back, then deport him again, but do it in the proper way. And by the way, don't cavalierly in the White House giggle as you talk about sending Americans down there as well. It is flirting with something we haven't seen in over 250 years of this country. And it is a rule of law country, and he, as the president, knows better.
All right, Jeannie Sheehan Zaino and Rick Davis, our political panel on this Tuesday. Thank you so much for joining us. And we still have more ahead here on Balance of Power as we turn back to tariff policy and the intersection with markets. That's next on Bloomberg TV and radio.
It's 1:40 on Wall Street. I'm Amy Morris. JP Morgan CEO Jamie Dimon is urging the U.S. to engage with China. He believes Treasury Secretary Scott Bessent should be negotiating trade agreements. Dimon tells the Financial Times he doesn't think decoupling from China should be the objective, but the U.S. should rely on itself or its close allies. Stocks getting whipsawed on lingering trade war risks. It's harder to say than you think. We check the markets for you all day long at Bloomberg. S&P 500 is little changed on the upside. NASDAQ is little changed on the downside. And the Dow is now down 12 points. The 10-year Treasury yield at 4.3% and the 2-year yield at 3.81%. Republicans in the White House, Senate, and House are drafting analyses on how to craft a new tax bracket for the wealthiest Americans. The House proposal would set the new rate at 40% for taxpayers earning $1 million or more per year, while the Trump administration is considering a higher threshold. The discussions are parts of efforts to pay for a sweeping tax bill by the end of this year, when several of President Trump's first-term cuts expire. Elliott Investment Management has built a large position worth more than $1.5 billion in Hewlett-Packard Enterprise and plans to engage with the company to boost value. HPE's stock has fallen roughly 33% this year, but right now, HPE has jumped nearly 4.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy, great to have you along today. And thanks for being with us here on the fastest show in politics, Balance of Power, live from Washington on Bloomberg TV and radio. You can always find us on YouTube as well. Search Bloomberg Business News Live. We're going to have a conversation as we stick with the markets here for a moment with Eric Friedman, Chief Investment Officer, U.S. Bank Asset Management. With Kaylee, the idea of uncertainty driving things for better or worse. Here we've apparently flattened things out for the most part today. It's not really a session to write home about. But when you consider the impact on the markets that we've seen over the past couple of weeks when it comes to tariffs, specifically, it's hard to overstate how powerful this has been.
Well, including the power to change Trump's mind about reciprocal tariffs, at least to a certain degree. As he noted last week, queasiness in the bond market and people getting yippy, and then announced the 90-day pause on the higher reciprocal rate for most countries. And of course, we understand that instrumental in helping the president make that decision were Wall Street voices within the administration, like the Treasury Secretary, Scott Bessent, who of course used to run a hedge fund, Key Square Group. And there's those kind of voices all throughout Republican politics. Commerce Secretary Howard Lutnick, formerly of Cantor Fitzgerald, I guess you could include in that as well. But another is actually the governor of Virginia, Glenn Youngkin, of course, used to be at Carlyle Group. And he joined our colleagues on Bloomberg Surveillance earlier today to talk about the policy and financial market bridge and the impact of tariffs overall.
The net of it is that President Trump was clear. He's continued to be clear that in resetting bad trade deals over the last decades and reestablishing reciprocal trade opportunities, by the way, with nations that are our allies. China's a whole different topic. But with nations that are our allies, we just need fair trade, and we haven't had it. And so, to reset those trade imbalances, you see him do what he does well, which is create space for negotiating. And I think that's exactly what's happening. When the first weekend after April 2nd, you read in every publication that 75 countries had called within a day to start the negotiations, and you've already seen those negotiations, at least reported in rumor. I think this will be this opportunity to take a big step in resetting this.
Hold on a second.
I think that's what the market needs to see.
Part of the problem, I think, and you know this very well, having invested heavily as a co-CEO of Carlyle and been investing in infrastructure, which takes a long time, there's a maturity mismatch between when some of this negotiation is happening, when these tariffs go on, and how long it takes to bring that investment to the United States. There is a lack of clarity about whether those policies will be continued in perpetuity, and it's leading to paralysis at so many companies. What do you tell the companies in your jurisdiction who come to you and say, how can I plan? How can I hire? How can I invest when this could change, when I don't even understand the parameters we're talking about?
Yeah, I have to disagree with you on the long-term planning, because we're seeing a pipeline of economic investment that has been as full as it's ever been. And these are long-term investments. Fortune 50 companies wanting to build in America and in Virginia, hopefully, if we can recruit them there. And these are long-term investments. And you saw NVIDIA yesterday talk about $500 billion. We've seen most of the big pharmaceutical companies commit to building in the United States. We're seeing technology investments, advanced manufacturing, all in the United States. These are long-term investments. I think the difference in a lot of people's understanding is that during market ups and downs, well, yes, IPOs get postponed, and yes, corporate deals get postponed, but these long-term commitments are actually coming in very large numbers, and that's good for states like Virginia. I mean, listen, we're in the SEC of economic development. I compete every day with Tennessee and North Carolina, South Carolina, Georgia, Florida, Texas, and we've got to compete. And I think that much of that investment will come to this region, and that is a long-term commitment.
The governor of Virginia, Glenn Youngkin, speaking on Bloomberg Surveillance on Bloomberg TV earlier today, speaking to the veracity of long-term investment here. There's a big question when it comes to what near-term investors are doing, whether it's stocks or bonds. That's why we wanted to spend some time with Eric Friedman, with our eyes on the markets here on the Politics Show. As I say, you can't separate them. He's the Chief Investment Officer, U.S. Bank Asset Management. Eric, great to have you. Welcome to Bloomberg TV and radio. You write that we've shifted from a glass half full perspective to a glass half spilled perspective. So how do we get the water back in the glass?
Yeah, I think it's a analogy that we're using more often than we'd like right now. And really, we look at this from a very apolitical lens from an investment standpoint. You all do a great job of covering both sides of the aisle. We have to think about this in terms of buying and selling. And ultimately, we really think that getting the water back in the glass really sits with the idea of what is the objective function we're trying to solve for here. And I think you've heard, including the governor's comments that you just played, this notion of the long-term economic plan. And that certainly is of interest to us as investors. But we also have to invest in something that's open, seemingly 24/7, which is the global capital markets, which aren't necessarily focused too much on the long term. So for us, really the key is, what is the spectrum of choices the administration wants to solve for? And is it partial reshoring? Is it more full reshoring? Is it just a more level playing field? Because there's so much nuance in what that objective function might be. In the meantime, we have to really focus on what is the actual economy doing. And that for us is probably the time difference between where we are right now and when some of these longer term, projections may actually come to play.
Well, and to your point on what will the economy be doing in the shorter term, as the administration, Eric, has talked about short-term pain, we got a take on what that pain actually could look like, or the probability of pain, from David Kostin, the chief equity strategist over at Goldman Sachs. This is what he told our colleagues on Open Interest this morning.
Well, certainly there's a high degree of uncertainty. Largely that's around the policy of the exact nature of the tariff and the likelihood or not whether there'll be a recession. And our economists here ascribe around a 45% probability of recession in the next 12 months. So the base case is, in fact, not a recession. The economy continues to grow.
Is a recession in your base case, Eric?
It's not, Kaylee. I think it's a great clip to play. And if you think about what I'm going to call, to bring in your colleague Tom Keene for a second, this now becomes a y-axis problem for investors like us, meaning what is the time difference between right now and resolution. So we felt coming into the pre-April 2nd period that the economy was certainly slowing, but still in a good spot. We had estimates, and we were about a 9-10% estimate growth for the S&P 500 in terms of earnings for this year. That's probably going to come down to something more flattish, if even potentially negative. So as you have more time that goes on, we actually have more vulnerability, particularly with middle-income consumers. That was the most vulnerable consumer set heading into the April 2nd news. This was a group that's done okay from an employment standpoint, has done okay with respect to wages, but we think we avoid recession as long as we get that objective function clarity. Let's call it in a matter of 60 to 90 days. If this goes past the current pause to tariff deadlines, that's where we could see consumers really starting to question the end game here. So I think that, again, this notion of the economy will likely be able to endure this uncertainty for a period of, let's call it 60 to 90 days. More than that, that's when you have both businesses and consumers really questioning what they should do. And when businesses and investors think about questioning, if you will, they pull back. They don't double down, if you will. So that's why we think we'll avoid a recession. But again, this y-axis problem is in the administration's hand right now.
Well, without getting into Tom Keene's triple leveraged cash, I do wonder if you're waiting with your own money here. Is it 60 to 90 days before you put new money to work?
You know, we've been saying our clients really fall in 3 buckets. Bucket one would be those clients who are in, let's call it the right asset allocation for their time horizon. They're fine. They're in a good spot. We have a ton of global exposures that go beyond the bond and stock market, so they're in a good spot. Those clients that have an excess of cash for whatever reason, those clients we've been saying, hey, use this volatility as your friend, be more incremental, piece in. But for those clients that are probably overweight domestic equity exposure, that they've really been riding that wave, if you will, which has not been our advice, but they've been sort of sticking with it. We've been saying, hey, this is an opportunity on big up days to reduce and broaden out. So we don't think we have to wait 60 to 90 days for this to be fully resolved. But some inklings, again, you did a great job reporting on this earlier. The European Trade Union lead negotiator is also unclear about what the end game is. We need more concrete messaging about, hey, we're on a path towards resolution here. Until we get that, we think this back and forth likely continues. We'd be concerned if the S&P retested that 4,800 level, which again we saw on Monday of last week.
Yeah.
We think we're going to grind it out between 4,800 and probably 5,600 in the S&P for some time. The 10-year, again north of 450, 460. That becomes a little more of a concern on our radar screen, but we think we probably live in those ranges in the immediate term. But again, that resolution and a path towards outcomes is what we're looking for to get more comfortable with putting fresh money to work here.
Well, and it's interesting to hear your comments on kind of cash allocation, knowing we got the latest Bank of America fund managers survey today. And the strategist led by Michael Hartnett there said they do not see peak fear yet reflected in the market or in cash allocation, which currently stands at about 4.8% of assets. They say they see max bearishness on the macro, with actually investor sentiment around economic prospects the lowest in 30 years, but not quite max bearishness on the market. And Eric, if we haven't reached max bearishness yet, words can be difficult at times like these, does that suggest we might actually see a retesting of those lows you were talking about?
Yeah, I think that we haven't seen what I'm going to call that capitulatory action, if you will, Kaylee. And so what would that mean? That would mean a really sharp spike in the VIX. That would mean that put-call ratios get highly skewed towards puts. And we see the, hey, let's sell, not what I want to, but what I have to. We haven't seen that moment. We got close to it a week ago yesterday, just with respect to the Monday print, just given a lot of back and forth over that preceding weekend, but we didn't see it. And so that doesn't mean we have to see it. Again, our viewpoint is that if we can live within this range in the 10-year between, let's call it 4 to 475, and again, S&P 4,800 to 5,400, and ultimately 5,600. That to us would be, a level of let's not call it complacency, but that says that the market is okay with these negotiations pressing. We get concerned if we get closer to that 90 days and there aren't signs of more concrete resolutions occurring, and that's going to happen more on the ground. That's why we'll be certainly focused in on what you're reporting, because again, for all the things we look at in terms of data, we're paying a lot of attention to high frequency data, but in terms of how those negotiations actually are going on the ground, that for us is certainly sitting front seat for markets right now.
Just 1 minute left here, Eric. This has been fascinating, and we appreciate your insights here with what you're saying. If I'm reading you correctly, is Wall Street will be dependent upon Washington and specifically tariff policy, maybe for the rest of the year. Do tariffs impact your year-end target? Will you even go there?
Yeah, I mean, we think that this is going to be a case where, just to talk about our earnings estimates, we felt that coming into this year, we thought that, up 10% from a growth standpoint on earnings was more likely. And that put a number on the S&P that was, had a 6 in front of it. We think that probably something with a 5 in front of it is more important, for this year. I would say this just really quickly. Ultimately, this is, a resolvable issue But we need to see, again, the end game. Is this about isolating China? Is this about gaining a broader consortium of non-China countries? And there's lots of spots in between. But again, we think that the markets are not going to wait for tax reform to kick in, which of course you've done a great job of covering. There needs to be some more guidance before we start focusing on tax reform.
All right, we appreciate your kind words and your insight. Eric Friedman, Chief Investment Officer for U.S. Bank Asset Management. And we'll be back for more in the late edition of Balance of Power on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And very good afternoon, everybody. Yep, it is tax day, Tuesday, April 15th.
Thank you for the reminder. Thank you.
Yeah.
Thank you.
Did you mail it?
I did.
Okay.
I did.
Good
I don't know
stuff.
if it's arrived, but
but it's
there, yeah.
out the door, headed for the IRS. Hey, listen, a lot going on today. Welcome. I'm Carol Massar along with Tim Stanovic. Yeah, we got bank earnings. That is certainly on our plate. We're watching that. But what's really interesting is we've got a rally that's running out of steam, and we've got a slew of headlines, again, trying to make sense of all of the things coming out of the White House when it comes to tariffs, what might happen, what might not happen. There's a lot.
Yeah, there is a lot. And speaking of that, how Mar-a-Lago, yes, that Mar-a-Lago helps explain President Trump's tariff obsession. We're doing a deep dive with Josh Green in just a minute.
Love this story. And speaking of such, we take a look at General Motors and its 8-year, $35 billion EV bet that is bracing for a hit, thanks indeed to tariffs. So there's definitely a theme for us on this Tuesday. All right, let's get you going. Let's get a check on that trade and that market fizzle. For that, we turn things over to Amy Moore. She's in for Charlie Pellet. Hey, Amy.
Hey, Carol. Stocks did get whipsawed once again. A slew of headlines on President Trump's fast-evolving tariff war with top trade partners has left investors unwilling to take on too much risk after a 2-day rally. So let's check those markets. We do it for you all day long here at Bloomberg. The S&P 500, little changed on the downside. It's down like 1 point now. NASDAQ is down 11 points. The Dow down 39 points. The 10-year Treasury yield at 4.30%. 2-year yield at 3.81%. The Canadian government said it will allow automakers to import a number of U.S.-made cars and trucks without tariffs, as long as the companies keep manufacturing vehicles in Canada. The government also said it will provide a 6-month reprieve on imports from the U.S. used in Canadian manufacturing, processing, food and beverage packaging, and certain items related to public health. And the U.S. economy is expected to lose billions of dollars in revenue this year because of a decline in foreign tourism and boycotts of American products. Arrivals of non-citizens to the U.S. by plane dropped almost 10% in March from a year before, with international travelers spending a record $254 billion in the U.S. last year. Now, the decline in foreign tourism is attributed to increased hostility at the border and rising geopolitical frictions. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Massar and Tim Stanovic.
All right, great stuff. Amy Morris, thank you so much. Amy in there for Charlie Pellet. Well, it is the most beautiful word. And so he says this, and it is a word he says a lot, and has been for a very, very long time. We're talking about the president.
Tariff. I am a tariff man. To me, the most beautiful word in the dictionary is tariff. Build your plant in the United States and you don't have any tariffs. We will establish a minimum baseline tariff of 10%. You notice that on the chart? And that'll be on other countries to help rebuild our economy and to prevent cheating. The tariffs give us great power to negotiate. Always have. And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch.
Well, and I got to say, if you talk to our Bloomberg News team who visited Mar-a-Lago last summer to talk to then candidate Donald Trump, tariffs definitely came up in their conversation and interview with him as well, or at least somebody who also liked tariffs. Writing about Trump's fascination with them and the Mar-a-Lago connection, let's head to Washington, D.C. and Bloomberg Business Week national correspondent Josh Green. Josh, we all do remember the cover story of Business Week ahead of the presidential elections, a picture of Donald Trump. You and a group of Bloomberg editorial, really our finest, went to Mar-a-Lago to talk with him, interview him. Take us back there and some of the things that you guys covered and what really struck you the most, maybe surprised you the most.
Yeah, so last July, we went down to Mar-a-Lago to interview Trump. A team of us did from Business Week a couple days before his first and what turned out to be infamous debate with Joe Biden. Trump had, wrapped up the Republican nomination. And so we were down there to talk about what Trump's plans for the economy would look like in a second term. And so we covered what we thought were all the major issues, tax cuts, deregulation, climate, the Federal Reserve, what his plans were for Jerome Powell. But Trump kept bringing up William McKinley, unprompted, the 25th president. And as we were leaving the interview, me and my colleagues kind of looked at each other and thought, that was a little odd. Haven't heard Trump bring up William McKinley before. And I thought about that on Liberation Day, April 2nd, when Trump instituted this global regime of tariffs that temporarily crashed the stock market, have a lot of banks and analysts worried about recession calls. And so in the new issue of Business Week, I kind of went back over that interview because I think in hindsight it offered a lot of insight into kind of the way Trump's mind works, especially around tariffs, and kind of what he might be thinking and what might be driving the obsession that you guys so ably illustrated there on the intro, that has Trump so keyed on ratcheting up tariffs, even as stock markets are falling around the world and a lot of people are worrying more and more about recessions.
I mean, you can go back and read that story, the cover of Business Week. It was the August issue, and a lot has certainly changed since then. I mean, even back then he was running against Joe Biden. But, Josh, I still think tariffs caught a lot of people off guard, even if you go back, as you write, to members of his inner circle, his administration. Even back then, they didn't necessarily think that he would do what he did on April 2nd. Why did it catch everyone off guard?
I think it caught everybody off guard for a couple of reasons. Number one, obviously Trump cared and instituted tariffs during his first term, but he did it at a level that wasn't so extreme that markets sort of plunged right away. A lot of people thought that, of course, Trump is going to do something on tariffs. He'll probably do something on tariffs in China, maybe some other sectoral tariffs around the margins. But he's not going to do anything extreme. I think that was the belief, because most economists on the right and the left agree that tariffs are inflationary, including his own Treasury Secretary, Scott Bessent, who I mentioned in the piece. I think the other reason, though, is that a lot of folks believe that Trump's rhetoric around tariffs was really a negotiating ploy. And there was a kind of comfort, I think in hindsight, false comfort, in the conventional wisdom that while Trump talked a big game on tariffs, what he really cared about was the stock market. And he views that as kind of like an imprimatur of his own success. If the stock market's high, Trump gets on social media and brags about it. I think the belief was that if it dropped too low, Trump would stop whatever he was doing to drive it down and do whatever he could to talk it back up. And that really hasn't happened much this time around. He did relent on some of the tariffs, but we're now in this sort of 90-day holding period where he may reinstitute them, and he's ratcheted up other tariffs on China. So I think people just misread and misunderstood, and I would certainly include myself in this camp, the degree to which Trump was intent upon raising up these tariffs. And so my piece explores why that might be and what we might have missed the first time around.
Yeah, I got to tell you, this idea, and you say this, that to take the president, at least the first time around, take him seriously, but not literally. And now we realize, wait, no, he really wants us to take him literally. That was all wrong. And so, since our read on President Trump was not necessarily on the money, or the guardrails were there during the first term, and it's different this time around, we don't really know, Josh, what comes next, do we?
No, and when I say we, that includes Trump's inner circle, because we talked to a lot of them, and a lot of them were blindsided. I actually moderated a panel discussion on Liberation Day with one of his former top advisors, Steve Bannon, and I asked Bannon on stage, do you know what's coming? What countries are going to get hit? And he said, well, this is all still up in the air. It's still being litigated. So even Trump's closest allies didn't really know what was coming then, and I'm pretty confident don't know what's coming next, because Trump is an impulsive guy. He reacts to what other countries do, and so really anything could happen looking forward. So what I tried to do was kind of go back to what I think of as first principles when it comes to Trump and tariff, and explore a little bit what his motivation might be and what he might be thinking.
So let's talk a little bit about that and kind of go more with what Bannon told you then and what you've learned from Steve Bannon. We should note you're also the author of Devil's Bargain, a book that really goes deep on Steve Bannon, among other books that you've written, Josh. So you've spent many years reporting on him, writing about him. You know him really well. What did we learn about his goals, President Trump's goals, through Steve Bannon?
Well, I think I've spent the last couple of weeks going around to people in Trump's orbit, people on Wall Street, people on politics, and saying, what do you think is driving Trump's obsession with tariffs? How does he view them, and why is he moving in a direction that seems to run counter to the economic interests of the United States and his own administration, or at least that's the argument that a lot of people have been making? I thought one of the best answers came from Steve Bannon. Bannon said that Trump looks at the United States much in the same way that he looks like Mar-a-Lago, his private club, as this prime piece of real estate, and that foreign countries should have to pay more, essentially a VIP rate, to have access to America's market. And that made me recall like an odd thing that had happened during this Business Week Trump interview last July. In the middle of the interview, the club manager for Mar-a-Lago wandered in, and Trump stopped the interview, called him over, and had him sort of boast to us, the Bloomberg reporters, about how Trump was raising club dues at Mar-a-Lago from $700,000 to $1 million. And, you know, in hindsight, I really do think that sheds some light on the way that Trump's mind works when it comes to tariffs. He was making clear to us at the time, you know, Trump felt vindicated. He'd been ostracized from politics briefly after January 6th, but he'd managed to kind of return and climb back and win the GOP nomination in a rout. People now wanted to be close to him, important people, business leaders, and so he was raising the price of admission to his club. And I think the same view kind of prevails for Trump when it comes to the United States trading with foreign countries, that Trump views the U.S. market as a prime piece of real estate. He's gotten into office, and now what he's going to do is sort of raise the membership fees for countries who want to do business with the United States. That's really what these tariffs are. You know, never mind the economic effects, the side effects, and the ripple effects that this has had on international trade patterns, on equities markets around the world, on the uncertainty it's caused for U.S. and foreign businesses. That's what seems to be driving Trump. And I found that a pretty compelling answer from Bannon and a pretty compelling insight into the way that Trump's mind works when he thinks about these big issues.
I think it's safe to say that I think both Tim and I felt like when we read it, we're like, oh my gosh, like a light bulb. Like, it just makes sense. And you know what's interesting, Josh? Like everybody keeps talking about the Mar-a-Lago Accord, but I think this kind of Mar-a-Lago connection makes so much and explains what he's doing. You know, some of the concerns, you just kind of laid out some of the things that, is it kind of short-sighted? Like his ability to use his power here as president and the U.S. economy and all its might in terms of negotiating better trade deals, but it might be short-sighted in that there are longer-term implications, certainly, for the U.S. economy and the U.S.'s position in the world.
Yeah, absolutely. I mean, within, what, a week, you know, we were on the cusp of a bear market. Now, the markets have rebounded since when Trump relented a little bit, but all the messaging we get from the White House is more tariffs are coming, he's going to ratchet it up. And look, it's difficult to go, as his Treasury Secretary, Scott Bessent, now intends to do, and negotiate individual trade deals with, I think, 70-odd countries in the next 90 days. So this has caused an awful lot of chaos. We've seen business sentiment, consumer sentiment plunging in the wake of Liberation Day. And so, you know, seemingly he's created a kind of macroeconomic problem for himself, for the United States, for his position in the world, that seems to be largely self-inflicted. And so I think there's still a lot of puzzlement and a lot of fear, including among Trump supporters and some of whom I talked to for the piece, about what exactly the plan and the intention is here, and what kind of damage may come as a result of that. And I think that's the thing we're going to see play out over the rest of the year.
Does it seem like to you that the president is less concerned about the bond market and the equity market this time around than he was during his first term?
Much less concerned. Much less concerned.
Why is that?
Bloomberg it's not exactly clear to me why it is. I think part of it is that Trump is more insulated from bad news in this administration than he was in previous administrations. I've seen some reporting, I've talked to some people who tell me that Trump is being told by a lot of his pro-tariff advisors that, hey, the working class really loves these tariffs, they're popular, you're doing a good thing here, when most public opinion would indicate the opposite. I talk in my Business Week piece about just how singularly unpopular Trump's tariffs are with a lot of voters across partisan groups, across age groups, across income groups. So he may be getting bad information about this. I do think that reality sort of pierced that inner circle a little bit. You saw this when the bond market began to fall apart a week or so ago, and Scott Bessent, among others, jumped in and convinced Trump to relent temporarily. But we really don't know whether they've changed his views and whether they've curbed his appetite to keep imposing these tariffs on allies and enemies alike.
Josh, I'm curious in all your reporting, and I mean this with no disrespect in terms of the president, not you, but I mean, just
thanks, Carol.
No.
Josh,
you know I adore. But I mean, sorry, that came out wrong. It's one of those days. What I mean is, you know, I was thinking about his fascination with McKinley, right? And if you really go back and read history books and so on and so forth, you realize how that just turned out so badly. Does the president read history? Does he read? You know, I am curious. I know there's a lot that probably crosses his desks and he relies on advisors, as a lot of presidents do, right? For some reason, so on and so forth. Yeah. But a lot of past presidents have also been incredible readers, right? In trying to understand situations. What do we know about President Trump in terms of how he assesses a situation?
I have wondered this myself. Trump definitely does read, but what he tends to read are paper printouts of like computer screens. Like I was in his office once interviewing him, and he had a folder of like paper printouts from the Drudge Report. So I don't think he's reading history books about the McKinley era. Yet at the same time, and you can go back and actually read the unredacted transcript of our interview with Trump from July, he makes several specific citations to things like the McKinley Tariff Act of 1890. So clearly he had been either reading or well briefed on a lot of what he was talking about, this kind of late 19th century American history and McKinley and tariffs. So it's kind of a mystery to me, and one I've wondered a lot about. Who exactly imparted this information to him, how he absorbed it. But clearly it's something that he's really keyed on and continues to key on. It's shaped and affected his worldview, and it's obviously affecting U.S. policy like right now in the moment. So it's something I hope to keep kind of doing more reporting on. But I have to be honest, it's a little baffling to me to understand quite how he became so obsessed with McKinley. I suspect it was somebody around him, an advisor, whether Peter Navarro or a Steve Bannon, someone like that, who really is pro-tariffs, had kind of filled his head with this stuff. But Trump was pretty bought in then, and still seems pretty bought in now.
So Josh, based on the reporting that you've done, the time you've spent with the president in recent years, the time you've spent with Steve Bannon and other close advisors to the president, what do you think our audience needs to understand about the longevity of tariffs and how they will be present in our lives during this administration?
I think the main thing is like tariffs are a core Donald Trump belief going back as long as he has commented on public policy. So I think he means this. He isn't doing these things or taking these positions opportunistically. This is core to his being and how he sees the world. As I write in the Business Week piece, generally when presidents have a big idea, all presidents, they tend to cling to it come hell or high water, whether things are going well or whether they're not going well. And so I would expect Trump, while he may relent on the margins, while he may adjust things on the tariff front, to stick with these as a key policy tool throughout his administration. So I think it's something people are going to have to watch and continue to grapple with.
So basically TBD, and time will tell, right? If he does stick to his guns, how it all plays out for all of us, or whether there could be some really serious consequences for individuals in this country as well as the U.S. economy, as many economists predict, Josh.
I think that's exactly right. And the only thing I feel any confidence about as somebody who's done a lot of reporting on him and the people around him is that tariffs are not something that he's going to suddenly lose interest in and disappear and go away the way a lot of folks would like to. I think they're going to be here for the duration.
So appreciate it. And see, I totally respect everything you do. Josh, thank you so much. An incredible piece of reporting. Bloomberg Business Week national correspondent Josh Green out there in D.C. All right, coming up next, amid the tariff kerfuffle, I'm kind of liking that word that Jamie Dimon recently used.
Other people have said it too.
I know. I just kind of like it. It's in my mind.
The way that he does speak, it kind of like leaves us with things to keep repeating for a few weeks.
I know, right?
Like, yeah, it really does.
It
does. It stays with us for sure.
So amid the tariff kerfuffle, we're going to stay with it. Understanding American power in the age of economic warfare. Columbia's Edward Fishman back with us to talk choke points. That's coming up on Bloomberg Business Week Daily. Stay with us.
It's 2:21 on Wall Street. I'm Amy Morris. Stocks volatile again today. Investors reacting to headlines about President Trump's tariff war with top trade partners. We check those markets for you all day long here at Bloomberg. The S&P 500 down 0.4%. NASDAQ down about 0.5%. The Dow is down 0.4%. The 10-year Treasury yield at 4.32% and the 2-year yield at 3.83%. Gold now 0.5% higher, and the Bloomberg Dollar Spot Index is 0.6% higher. The European Union and the U.S. have made little progress in bridging those trade differences. U.S. officials indicating that most U.S. tariffs on the EU will not be removed. The EU has offered to remove all tariffs on industrial goods, including cars, but the U.S. has rejected that, instead suggesting some tariffs be offset by increasing investments in exports. The EU has agreed to delay implementing counter tariffs against the U.S. for 90 days, but will impose them if these negotiations don't pan out. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Mazur and Tim Stenivek.
All right, Amy, thank you so much. All right. Obviously, as we kicked off our hour, we talked about how there's a lot still continuing to come at investors when it comes to trade and tariffs, the tit for tat. You've got the EU and U.S. not making much progress when it comes to their trade differences. China has stopped taking orders when it comes to deliveries of Boeing jets. The Trump administration has inherited has initiated, I should say, some trade probes when it comes to semiconductors and pharma imports. The trade flow continues and the tariffs continue or seem to be. So we wanted to once again check in with Edward Fishman. He's senior research scholar, a professor at Columbia University School of International and Public Affairs. We recently talked with him about his new book, Choke Points, American Power in the Age of Economic Warfare, and he is back here in our studio. It is good to have you here, because as this continues to go on, the longer it goes on, we continue to think about what are the economic repercussions that could be the future of the U.S. How are you thinking about that? How is it kind of evolving the longer this goes on?
Yeah, well, first of all, thanks for having me back on, Carol. So look, a big theme of my book, Choke Points, is that there are these choke points in the global economy, areas where one country has a dominant position and there are few, if any, substitutes. And these choke points have been what have been primarily used for economic warfare. The dollar and the U.S. financial system is the most important choke point in the global economy. It's the one that America has relied on for sanctions against Iran, Russia. And the thing that has been...
Because by everything being dollar denominated, that means in order to transact, right, it's got to go through dollars. And basically, we have control over dollar-denominated assets.
That's exactly right.
And those points throughout the financial system.
That's right. I mean, I think if you just look at it from a numbers basis, I mean, America is something like 10% of global trade, and 90% of foreign exchange transactions involve the dollar. So the dollar is being used in transactions that have nothing to do with U.S. goods being traded from one country to another. So I think the thing that has been most concerning to me, frankly, over the last week or two of when Trump has really escalated the use of tariffs is we have seen, I think, for the first time, at least in my professional life, real concerns that the dollar may be losing some of its safe haven status. And this obviously is concerning from the perspective that we all understand in terms of the dollar's role as the world's reserve currency is necessary for the way that we run our political economy, the way that we fund budget deficits. But I think also from a geopolitical perspective, there are concerns that if we were to undermine the dollar's role in the international financial system, it would significantly constrain the ability of the U.S. government to impose impactful sanctions on foreign countries.
The impactful sanctions is certainly one part of this, but the other part of this is the global economic world order, or the economic world order, I should say. And just the fact that the U.S. and the dollar have really stood at the intersection of so much. When you talk about that being at risk, what exactly do you mean? What, in your view, could happen?
Right. So what would it mean for the dollar to lose its position as the world's reserve currency? I think at the very baseline level of it, the dollar, by virtue of basically there being limitless demand for American treasuries, we have not had to balance our budget in decades, right? So I think were the dollar actually to just be another currency and U.S. treasuries just to be another form of sovereign debt, we'd actually have to worry about things like what does our fiscal situation look like in the United States?
Explain that, carry that out for people who may be like, I'm not making the connection. Because I think so much of what's happening in the last week and a half, we have to understand how this all connects, right? Because I think people, I don't know, just walk it through for us.
Sure, yeah. So right now we run deficits, budget deficits every year at something like 7% of GDP, which is significantly higher than it has been historically. What that means is we take in less revenue than we spend as a federal government.
Right.
The way that we plug that deficit, the way that we finance the spending that doesn't come from American taxpayers is through issuing debt that then is in the form of U.S. Treasuries, right? Part of the reason that there's effectively limitless demand for U.S. Treasuries is because of the dollar's role as the world's reserve currency, because it's considered this safe asset that, you know, in any time of need, basically you can always turn it into cash at a relatively stable level. But what we've seen in the last week is something that's quite unusual, where Treasury yields have gone up as the dollar's value has actually weakened.
Right.
Because normally you'd expect as Treasury yields go up that the dollar would strengthen because there'd be more demand for American assets. What this suggests is that there's something going on, that there might be this new risk premium being built in to American assets that hasn't existed before.
The new risk premium notwithstanding, what would you say to somebody who's listening right now or watching right now and says, wait a second, this could be a good thing for the United States to start only spending the money that it has every year?
It's a fair point. At the same time, it would require a massive change in how all of our lives work, right? Because the lion's share of American federal outlays every year are in things like Medicare, Social Security, entitlement programs that Americans rely on.
Yeah, so, I think Elon Musk has brought that to attention many times over the last couple of months when talking Doge.
Right, although that has not been a focus of Doge, right?
Exactly.
If anything, you've seen expansion in things like Medicare Advantage payments, right? That has been covered in other Bloomberg media recently. So look, I think that we would have to have a substantial cut in government spending, and by the way, a concomitant rise in taxes. But I think there's a broader point that's more near term, because there are people in the Trump administration orbit who actually view the dollar's role as the world's reserve currency as bad for the U.S. economy, not an exorbitant privilege, but something that undermines our export competitiveness. Because just to spell this out in sort of plain
Makes
English,
our goods more expensive.
Exactly, right. But what we're seeing is that, yes, if the dollar is valued at a lower level, then there will be specific sectors of the American economy that may be more competitive on global markets, right? But everyone is hurt by a weaker dollar, because also all of us in the United States are paid in dollars. So if our dollars are less valuable,
right,
we have lower purchasing power and we are poor, right? Our paychecks go less. They don't buy as much for us.
Isn't it also important to talk about trade deficits? Everybody thinks bad trade deficit, but that also has implications as well in terms of demand for dollars, right? And it also, we want to be buying things because that gives people dollars, and they in turn can buy U.S.-based assets. Right? There's like this relationship as well.
That's right. Yeah. I mean, the flip side of a trade deficit is that we have, financial asset financing that's coming into the United States. Right. We have other countries who are investing in American assets. Right. So that is, why you need the current account and the capital account have to balance. So a current account deficit will mean a capital account surplus. Right. So that's right. I think if you truly were able to balance American trade, you would, by definition, have less capital coming into the United States.
Can I also ask you, don't we have a service surplus?
We do, yes.
And is that a good or bad thing?
I think it's a great thing. I mean, look, I think there's been this, memes now about should Americans be, screwing in screws in iPhones or something like that.
Right.
I think most Americans, frankly, would rather work a services job for the same pay than working in a factory.
Well, that was the whole idea with globalization in the 1990s. If you go back, and that was sort of the promise that we were told by politicians.
That's right.
Let's move the jobs to other countries, and what we'll do is we'll retrain the workforce here so they can do more service-oriented jobs and jobs that are in a different part of the economy. That didn't end up happening.
Well, I mean, to be fair, up until recently, we've been at full employment. So we haven't had massive unemployment in the United States.
True, but I mean, if you go back even to the first Trump administration and the analysis of why he won states and why Democrats lost in a lot of these areas, there was a lot of criticism that these were areas that had been hollowed out with the loss of jobs moving abroad. And that seems to be still what the president is speaking to at this point, to go back to an era where those manufacturing jobs come back.
Yes. Look, I think that clearly there have been regional effects that have not been distributed equally. And there are parts of, for instance, my home state of Pennsylvania that have been really hit hard by this process, right? And so I do think that the federal government has not done a particularly good job at figuring out how to, continue to provide a decent standard of living for people in these regions of the United States. What I would say, though, and if we're going to take Trump's arguments about manufacturing seriously, I think the best argument isn't so much about unemployment, because as we've discussed, we have been at full employment. There is a lot of service sector employment in the United States, right?
Right.
The best argument is really the national security argument, where there are potentially some aspects of manufacturing where you would want domestic sources, right? And by the way, even Joe Biden, going back to his presidency, imposed 100% tariffs on Chinese electric vehicles because there was a view that we didn't want BYD to eat Tesla's lunch, right? We didn't want Chinese EVs that were better, more efficient, cheaper than, the EVs made by Tesla and GM to come in and swamp the American market, because it's a security concern if we're dependent on Chinese cars, right? So I think there are specific sectors where this is a relevant point for national security. The harder,
I mean, we have defense manufacturers.
Pharmaceuticals,
So we really,
pharmaceuticals,
right? Exactly.
I agree. And I've written an essay in the Boston Globe a month ago in association with my book Choke Points about the pharmaceutical supply chain. This is something that certainly the United States needs, not only more domestic sources of manufacturing, but what I would call trusted supply chains, right? You don't want to be reliant on China for, pharmaceutical additives, right? Do we want to do everything domestically? Do we want autarky? I don't think so. But do we want to be less reliant on adversaries like China? I think that's a very worthy national security goal.
So going back to your book, Choke Points, I'm thinking about China and how they are wielding kind of their choke points. I thought about the tariffs and the kind of salvo that they lobbied back at the United States when it comes to rare earth minerals. Like, that is very targeted, and many would say very, very smart because of their incredible control over it. It's not that we don't have it, but they are set up in a much more productive system, right, in terms of refining and so on and so forth. Walk us through that and how they are fighting back.
Yes, thank you for bringing this up, Carol, because I think one of the things I've been most frustrated about in terms of the coverage of the U.S.-China situation in the last week is this discussion of a trade war, right? We're not seeing a trade war. We're seeing something much broader. We're seeing a multi-domain economic war in which tariffs are just one weapon that's being used. And in fact, they're not even the most powerful weapon.
Yeah.
If you look at how China's retaliating, right? Yes, they have tariffs that they put on American imports. But if you're just going tariff for tariff, America has more to tariff than China has to tariff, because we're importing a lot more from China than they're importing from us. But what China's been doing since 2018, since the first salvo of tariffs came into place, they've been preparing things like export controls on critical minerals that America relies on, from everything from batteries to ammunition, right? They've been sanctioning U.S. companies. So PVH got sanctioned recently. Skydio, the biggest drone manufacturer in Silicon Valley, was sanctioned, and now they've got to ration batteries. Each customer now only gets one battery per drone, right? Which is pretty absurd when you think about it.
Yeah.
Illumina, the big DNA sequencing company, got sanctioned by China. You're also seeing things like anti-monopoly investigations into NVIDIA and Alphabet, right? So China is not retaliating in sort of a symmetric manner only. They're also fighting asymmetrically.
Yeah, great stuff. Thank you so much.
Yeah,
so
my
appreciate that you could come in. Edward Fishman, Senior Research Scholar and Professor up at Columbia. His book is Choke Points, American Power in the Age of Economic Welfare. This is Bloomberg Business Week Daily.
It's 2:40 on Wall Street. I'm Amy Morris. President Trump calling on China to reach out to him to start negotiations to resolve the escalating trade fight between the U.S. and China. J.P. Morgan CEO Jamie Dimon urging the U.S. to engage. He believes Treasury Secretary Scott Bessent should be the one negotiating these trade agreements, telling the Financial Times he doesn't think decoupling from China should be the objective, but the U.S. should rely on itself or its close allies. Stocks are whipsawed over tariff war headlines. We do check markets for you all day long at Bloomberg. The S&P 500 down 0.1%, NASDAQ down 0.2%, the Dow down 0.2%, the Russell 2000 index down 0.1%, the 10-year Treasury yield at 4.32%, and the 2-year yield at 3.82%. Republicans in the White House, the Senate, and the House are drafting analyses on how to craft a new tax bracket for the wealthiest Americans. The House proposal would set the new rate at 40% for taxpayers earning $1 million or more per year, while the Trump administration is considering a higher threshold. The discussions are parts of efforts to pay for a sweeping tax bill by the end of 2025, when several of President Trump's first-term cuts expire. Elliott Investment Management has built a large position worth over $1.5 billion in Hewlett-Packard Enterprise, planning to engage with the company to boost value. HPE stock has fallen roughly 33% this year, but today it has jumped more than 4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stinovic.
All right, got it, Amy. Thank you so much. Well, President Trump said he was considering tariff exemptions on imported vehicles and auto parts. That would be a big deal, big deal for U.S. automakers who, as you know, are facing numerous challenges. Take GM, who currently finds itself up against tariffs, an oil-loving president, and Elon Musk in the White House. That's a trifecta that can make it really tough. The story that we're going to talk about, among the most read on the Bloomberg terminal, it is the Bloomberg Big Take, which means our Bloomberg editorial team says it's a must-read. The story, too, featured in the upcoming new issue of Bloomberg Business Week, soon out on newsstands, already on the Bloomberg terminal and at Bloomberg.com. Let's get to it with Bloomberg News Detroit Bureau Chief David Welch. He is in our Detroit bureau. David, let's jump right in. I mean, GM, it has been on a mission when it comes to EVs, and now it finds itself in a tricky place. Lay it out for us.
Trump's desire to get rid of Joe Biden's EV tax credits that he talked about a lot on the campaign trail and since he's been in office. Both of those are bad things if you want to sell EVs. The tariffs alone, that's not exclusive to EVs, obviously, but GM's two most affordable EVs, Chevy Equinox and Chevy Blazer, they're assembled in Mexico. They would be USMCA compliant, so they wouldn't get hit with the full 25%, but they would face tariffs on the non-US parts content in them. So they would face some pressure, some sort of cost hike on them, and whether GM has to eat that, try to pass it on to consumers, that's something companies are working out with any vehicle they bring into the US from another market. It just adds more pressure for them. The bigger thing, though, really is Trump's pledge to get rid of EV tax credits, up to $7,500 for every consumer who buys one. And that's a way of bringing the higher prices, higher cost of EVs in line with internal combustion vehicles to make them more desirable, help automakers get sales up, therefore they get economies of scale going and they can reduce battery costs and just make this technology more affordable. So these are two things that don't help anyone, any company that's trying to sell EVs. But GM's got a dozen models on the market. They've got a lot of investment tied up in this. They haven't backed off nearly as much as other car companies have. So it puts pressure on them for this big push that they've had going on 8 years now.
So does it mean that GM will have to push back on this investment or pull back on this investment, as we've seen from other companies such as Ford, for example?
They could, and in some ways they have, right? There's a electric pickup truck plant outside Detroit. They've delayed the opening of that until next year. They're waiting to see, what electric pickup truck volume is, and that's been the slowest segment in the market for EV growth. And they sold out of a joint venture with LG to build a third battery plant in Michigan. But they've broken ground on another battery plant in Indiana that will make a different kind of battery cell. It's the one they want to use going forward. So while they have backed off, they haven't done like, say, Ford has, where Ford was going to make an electric vehicle in Ontario. They've instead decided to make pickup trucks in that plant. That's a big pullback there. And some others have slowed down some new vehicle launches and some investments. But overall, GM's got a pretty big push here. And you can see why. They're gaining market share with EVs. Their market share in the EV market itself doubled last year from 6 to 12%. And they do better with people who've never bought GM brands before. About 60% of buyers are new to General Motors. So they see this as a way to find a new buyer. And if they get costs down and they can get prices down, they'll continue to gain. So for them, it's an opportunity for growth and a new kind of buyer. And they also think it's the future. BYD of China is there. They're gaining market share in Mexico and South America and in Europe. And so GM wants to keep pushing this technology, and they want to be in that game. And not just give up on it because of near-term market pressure or near-term changes in the political winds out of Washington.
You mentioned BYD, so I got to go there. We were just speaking with Edward Fishman over at Columbia. He's got the new book, Choke Points, out. We just wrapped up that conversation. It's going to go in our weekend show if you missed it. But he mentioned that China vehicles and the fact that Biden put these 100% tariffs on Chinese EVs. So we're not going to see, BYD or Xiaomi vehicles here in the U.S. Why are the Chinese able to do these vehicles so much cheaper and I think some would argue better than American companies? What is it exactly?
Yeah, they've been at it for a longer amount of time here, which means they've got more sales volume. I think 30 to 40% of the Chinese market is now EVs. So that means you have better scales. You can get your battery costs down. They have a supply chain that's built up there and has been just developing, getting its costs down for a long time now. They do have some really good technology over there in terms of infotainment and that sort of thing, which makes the vehicles very appealing. But also, look, the Chinese government is pushing this pretty hard. In some cities, you can't even get a registration for your vehicle unless it's what they call a new energy vehicle, which is either a plug-in hybrid or an electric vehicle. So that's the stick side of it. And they've given the companies themselves over the last 10 or 15 years, we've got the number in my story, $230 billion in different subsidies. So part of it's the subsidies, part of it is policy. And we haven't had, nor has Europe, that kind of push for EVs the way the Chinese have. That's not to say they don't have good technology. BYD and Xiaomi and some of these companies have really great technology. But they've had, it's been a policy with the CCP to make this happen in China and become the dominant force in electric drive.
One thing I'm curious to, though, David, is you write in your story, GM loses money on every EV that it sells. Is this just a matter of, it needs to sell large numbers and then the cost of each comes down? Or is it that they've got to kind of retool or rethink how they are currently manufacturing?
It's really all of it. So, and there's a lot of this in the story. So GM's doing everything from, going through the factories and just wringing a couple hours here out of the assembly process and finding more efficient ways to do things. And remember, these vehicles are GM's first time EVs with the Ultium platform and with these models. So you always get efficiencies in subsequent model years. But they have that on the fast track. They're working hard, really, to get those costs down. And that's just basic car making. And then they're looking at ways to get their battery costs down, which they got $60 per kilowatt hour out of their battery last year. They're looking for another $30 this year, which would get them down to about $100 per kilowatt hour. And that's roughly, according to one analyst I talked to, where Tesla is. And if they keep pushing that, you start to get below $100 per kilowatt hour. For example, the Chevy Equinox has a 100 kilowatt hour battery, right? So if it's $100 at 100 kilowatt hours, that's a $10,000 battery. You start to get that, if you can cut that in half, you get closer to what an internal combustion vehicle would cost. So now there's still a cost penalty there, but if you get efficiencies in other places, you work toward getting the program profitable. They think they're going to cut the drag on earnings from EVs in half this year. And take $2 billion out of it. And they told me when I was working on the story, they're not that far off from being able to break even on these. And by the way, some of the vehicles are pretty expensive. So with higher sticker prices, lower costs, you can make money on electric Escalades and Hummers that sell for big amounts of money. And if you keep getting the costs down, you can make money on the others.
Well, it's a deep dive into what GM's been working on for the past 8 years and what's at stake here. David, thank you so much. Bloomberg News Detroit Bureau Chief David Welch out there in Detroit. Check out his Bloomberg Bloomberg Business Week story. It's in the upcoming new issue, soon out on newsstands and also at Bloomberg.com and on the Bloomberg. And you can also check out other coverage. There's a great new issue coming up, and it's all about trade. So look for some more stories on that. Hey, when we come back, we'll get an update on trading and some of the stocks on the move. This is Bloomberg Business Week Daily.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're coming up on an hour to go until we see the closing bell on Wall Street. And right now, we're definitely off our best levels of this session, down on both the S&P and the Dow, slightly higher than NASDAQ 100, just up about 22 points. Let's take a look at some stocks on the move on this Tuesday. With us is Bloomberg News Managing Editor for Bloomberg Markets here in studio, Christina Aquino. Good to have you here with us. We kick it off with a bank name.
Let's kick it off with the banks. Another great set of results for Bank of America and Citi. We have Bank of America record trading revenue again, coming in at just over $2 billion. And in top line revenue, highest in a decade, just over $27 billion. Citi also having an equally great quarter here, fixed sales and trading revenue beating estimates and getting ever closer to that profitability measure that Jane Fraser were targeting. We're looking at specifically the tangible common equity. She targeted that for 10% to 11% by the this is a set of results, I think, that surprised even Wells Fargo's Mike Mayo, really calling them surprising, all the optimism, because obviously the economic backdrop probably less optimistic, but yeah, volatility, banks love it.
Yeah. Big banks doing just fine. I'm looking at the KBW Bank Index. There's 24 names, 23 are higher in today's session. Only JP Morgan is slightly lower.
Could be a couple good gainers for you, Carol.
Yeah, I'm done.
Okay.
It's done.
Well, speaking of that, I think this one's on your list. Sit back and stream because Netflix is reporting soon.
Yeah, Netflix is reporting soon, but we did get an advanced look at what we're going to be expecting from them via the Wall Street Journal. They're reporting that Netflix aims to double its revenue and reach $1 trillion market cap by 2030. So it wants to join the $1 trillion market cap club. And, you know, analysts generally raving about this. BMO Capital Markets saying that, quote, these ambitious goals are achievable given a best-in-class leadership team. I have found myself watching more Netflix shows recently.
2030, though, that's like 4.5 years
Who
away.
doesn't want to be $1 trillion company?
But 4.5 years?
Yeah.
It's a lot of time.
I know, but
A lot can happen between now and then.
yes, that is true. But that's the job of these analysts to try to provide some sort of clarity on what they think is going to happen.
It's a good headline, right?
Very good headline.
$1 trillion market cap.
Now 5% higher for the day.
Yeah, up 10% for the year.
5.6% now.
That is a gainer, as you said.
Yes.
Let's get to Moderna. What's going on there?
Moderna not having such a good day today, down more than 3% at the moment. And that is because, you know, everyone's watching for this panel of CDC advisors that will be meeting for the first time under HHS Secretary Robert F. Kennedy Jr. They're going to be reviewing data, making recommendations on vaccine policy. And so investors are very much on guard for any changes that will come there, especially because this group will definitely evaluate several kinds of shots from all sorts of diseases. So investors just kind of probably staying on the sidelines a little bit until we know more. That meeting's going to happen until 5:30 today, and then again tomorrow from 8 a.m. to 5:10. So it could be some development soon.
What would you guys do if, like, the CDC is like, yeah, get a flu shot if you want, get a COVID shot if you want? Like, do they even then continue to make, like, new COVID shots? Right?
I don't know.
We get variations.
Yeah,
like
these are all the questions.
The flu question is a big one because
Right?
every year they're supposed
It's a new
to
one, right?
decide on which version of the flu shot they're going to make and which version of the flu they're going to have
Or
next
for
year.
kids, right?
Yeah,
This is
yeah.
like a huge deal.
Yeah, I mean, if you know, as anyone who has kids knows, when you go to the doctor, you know, they always say, well, these are the recommended vaccines
Mm-hmm.
for this age, and here's why. And those recommendations come from somewhere. So, yeah, this is
exactly.
important.
Could be a real change. Moderna, by the way, it's down almost 40% this year.
That's a loser.
It's a loser. Yeah, that's a big deal. I mean, listen, it had how many years, though, right, during COVID, where it was just on a tear?
Yeah, but I mean, if you go back and look at the highs from Moderna back in 2021 to right now, it's down 94%.
It was a
94%, Carol.
It was a $497 stock.
Yeah.
Yeah, I forgot about that. Boy, very, very different mode. Christine, thank you so much. Really, really appreciate that. Christine Aquino there with some of the stock movers at this hour. For more conversations, you should be checking out our Stock Movers podcast. We do it often throughout the day. They're 5-minute episodes of the biggest winners and losers that are happening in the stock market. You can find it at Apple, Spotify, or wherever you get your podcasts.
Moderna was in 2021 a $196 billion company.
What is it now?
$9.5 billion.
That's amazing.
Yeah, it's pretty remarkable.
Whoa. Right? Yeah. Okay. Right now, though, folks, if you're looking at the market, call it unchanged right now on the S&P 500. Definitely off our best levels of the session, down about 56 points on the Dow Jones Industrial Average, down about 0.1%. And the NASDAQ 100 holding on to some gains, just up about 0.25% or 47 points. But again, very different mode. Kind of when we kicked off this morning, it definitely was higher across the board. I think we were about 1% gains or so, but a definite tone. And we get some earnings after the close today.
Yeah, we do. We're going to hear from United Airlines, J.B. Hunt, Omnicom, and that's just a couple of the companies that we'll hear from this week. Netflix reports after the bell on Thursday.
I can't believe Netflix is already on Thursday, right? They come kind of fast and furious.
We always say it's like a bellwether for what's to come. I don't know if this year's any different, this quarter's any different.
And they're the one, listen, if they have problems, right, they're the standout when it comes to streaming.
Yeah,
so if there are some
no
issues,
question.
then we know that there could be some more problems. All right, folks, we are less than or almost an hour away from the closing bell on Wall Street. If you're watching on TV, the close is coming your way in just a moment. Tim and I continuing right here on Bloomberg Business Week.
Yeah, we're going all in on autos. We're speaking about EVs on the industrial side of EVs with Patrick Sullivan over at EV Realty. Keith Naughton is going to be joining us when it comes to auto parts. All that and more coming up next on Bloomberg Business Week Daily. This is Bloomberg.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. President Trump is squaring off with Harvard University, as Stacey Lynn reports.
White House Press Secretary Caroline Leavitt was asked about the president freezing billions of dollars in funding and threats to revoke the university's tax status.
President believes Harvard should
apologize for what she called the egregious anti-Semitism that took place on its campus.
Jewish American students or students of any faith should not be illegally harassed and targeted on our nation's college campuses.
Stacey Lynn, CBS News, the White House.
There is a court hearing today in the case of a Maryland man deported to El Salvador who the administration refuses to return and has offered few updates on, despite an order from a judge. CBS.
Point here. This could be a case where we're reaching a level where the judge may decide that she needs to hold someone in contempt. That's something that we haven't yet seen in any of these cases. We've seen them nearing that point.
President Trump says China has reneged on a major Boeing deal. Business reporter Jason Brooks.
The Chinese government, according to Bloomberg, is instructing the country's domestic airlines to stop taking deliveries of new aircraft ordered from Boeing in response to 145 on Chinese imports. The report says Beijing is also ordering carriers to suspend purchases of aircraft components and related equipment from U.S. suppliers.
Trump said today it is up to China, not the U.S., to come to the negotiating table on trade. Mark Zuckerberg was back on the stand today in the Meta antitrust case. CBS's Jolene Kent reports he's facing more questions about the acquisition of Instagram and WhatsApp.
Zuckerberg was looking and discussing email correspondence from way back in 2012, discussing competitors like Instagram, which of course is in the crosshairs in this entire case, of course, and the possibility of acquiring the app at that time.
Jury selections underway in New York in the retrial of disgraced movie mogul Harvey Weinstein. He's charged with rape and performing a criminal sex act. A woman has taken part in the Army's Best Ranger competition for the first time. Michael Wallace reports.
Army Ranger First Lieutenant Gabrielle White and her teammate finished in 14th place out of 52 pairs. During the 60-hour competition, the Rangers moved more than 60 miles. Along the way, there are physical fitness tests, obstacle courses, land navigation, helicopter missions, and weapons qualification. In past years, the Army likely would have touted White's accomplishment, but President Trump's anti-DEI policies won't allow that. Michael Wallace, CBS News.
The Dow is down 81. This is CBS News. There's a move underway to canonize a 19th century architect who left his mark on a city in Spain. Deborah Rodriguez has the story.
Pope Francis has put a celebrated Catalan architect on a path to sainthood. The next step would be beatification or verification of a miracle by Antoni Gaudí, a devout Catholic who was nicknamed God's architect for his work on Barcelona's Sagrada Familia Basilica, which began in the 1880s. The construction lasted for more than 4 decades and remains unfinished. Gaudí was hit by a tram in Barcelona in 1926 and taken to a hospital for the poor because no one recognized him. He died 3 days later. Deborah Rodriguez, CBS News.
Russia today sentenced 4 journalists it says were associated with the late opposition leader Alexei Navalny to more than 5 years in prison as part of an intensifying crackdown on press freedom there. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, we are just about an hour away, a little bit less from the closing bell here on Wall Street on this Tuesday, April 15th, tax day. And you've got stocks bouncing around the lows of the session. Little changes overall, though, for the major equity averages. NASDAQ holding on to a slight gain, up 0.2%. But if you look at the banks, Tim, definitely some outperformance there. The whole group up about 1.7%.
Yeah, we've heard from B of A. We've heard from Citi, the last of the big banks having reported. We got a great roundtable coming up in just a minute. Also, on cars, auto tariffs, and the future of EVs.
Yeah, could be an issue. Just a few issues. We talked about that a little bit last hour, but we'll see what two voices have to say on that. Hey, let's get you going with a check on the trade at this hour. Let's turn things over to Amy Morris. She is in for Charlie Bellett. Hey, Amy.
Hey, Carol. The Canadian government says it'll allow automakers to import a number of U.S.-made cars and trucks without tariffs, as long as those companies keep manufacturing vehicles in Canada. Canada will also provide a 6-month reprieve on imports from the U.S. used in Canadian manufacturing. We do check markets for you all day long here at Bloomberg. The S&P 500 is a little changed on the downside. So's NASDAQ. In fact, S&P is now down 3 points. NASDAQ down 5 points. The Dow is down 86 points. The 10-year Treasury yield at 4.33% and the 2-year yield at 3.83%. Bank of America, you just mentioned it, their shares are more than 4% higher after posting a record quarter as the company reaped the benefits of volatile markets and net interest income topped analyst estimates. CFO Alistair Borthwick spoke on this morning's earnings analyst call, saying that clients right now kind of in a holding pattern.
Firm-wide investment banking fees were $1.5 billion in Q1, similar to last year's first quarter. We maintained our number 3 investment banking fee position, and looking forward, we've got a healthy pipeline, and our clients are simply waiting on more clarity on trade policy and the regulatory environment before committing to deals.
Revenue from equity trading rose 17% in the first 3 months of the year, helping B of A beat analyst estimates for per-share earnings. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenivek.
Hey, thanks for that update, Amy. Do appreciate it.
How you doing over there?
I'm great. How are you doing?
I'm doing dandy.
Tax day. Don't forget.
I'm on extension.
She has an extension. She has extra.
It's all filed.
Okay, good. That's all that matters.
Done.
Hey, the last of the big banks have reported. Bank of America shares moving higher after stock traders there posted a record quarter. Over at Citigroup, the bank inched closer to a key profitability target in the first quarter as the firm's traders surpassed expectations, and the bank drew a record haul from its wealth and retail businesses. For more, we bring in Catherine Doherty and Sally Bakewell. Kat is Bloomberg News finance reporter. Sally is Bloomberg News America's finance team leader. They both join us here in the Bloomberg Interactive Brokers studio. Sally, we're going to start with you. We're going to talk Citi. These two are the last of the big banks to report. I think the big headline here is that the bank is getting closer and closer to this key profitability target that the CEO set out.
That is correct. And I think what was interesting with this earnings quarter from Citi is that beyond the numbers, which were good, there were records for retail and wealth, as you said, and the traders surpassed expectations thanks to this volatility, and they had a good performance from its services business. But what was also notable was how much the executives kind of exuded a lot of confidence and self-assurance about Citi's ability to maintain a strong position and also to navigate the economic uncertainty that is approaching. And indeed, Fraser was particularly forceful about that and voiced a lot of support for the US. Jane Fraser, the CEO, she voiced a lot of support for the US, said that when all is said and done, when we've got through these structural issues and the trade imbalances, the US will emerge victorious as the sort of world economic leader, and the dollar will remain the reserve currency.
I want what she's having. Where does she get that from? Sorry. Where does she get that from? Well, because you know what some of the other CEOs, the big banks, Jamie Dimon and others, right, have said, David Solomon of Goldman, I feel like have been a bit more cautious.
Well, she did also echo that cautiousness, and she kept their sort of same line, which is to say that things are impossible to predict right now.
Yeah.
But she probably was buoyed by some of the numbers and the fact that they do.
It's been such a slog for her, right?
It's been such a slog. They've had to cut nearly 20,000 members of staff. They've brought in new leaders. They've undertaken this dramatic modernization of infrastructure. And you can probably see in the numbers that they are starting to see progress and they are getting close to this profitability metric. But it is important to note that they do sort of front load that profitability metric. They often post a sort of more positive one and then it kind of cycles down through the quarters.
Why is that?
It might just be a sort of cyclical thing generally. But all that said and done, there were other positive signs. The consumer remains resilient, they said. So, the impacts of the sort of economic downturn aren't necessarily, potential economic downturn aren't necessarily filtering through there yet either. And they also said, even on the deal front, that their pipeline remains strong, robust and healthy, despite the fact that there is a sort of chilling effect of a lot of Trump's tariffs.
It's so interesting to hear this because if we were sitting here a week ago, we'd be going through the list of the companies that have pulled their IPOs. We'd be talking about risks to capital markets businesses at these big international banks because of a pullback in M&A, a pullback in IPOs. And that's just not the impression that we got Friday, Monday, and today.
Right. I mean, they did acknowledge, and they have acknowledged for a little while, that a lot of their corporate clients are pausing is the word that they're using, as they assess and wait for more clarity. But they did seem to emphasize that they do have these pipelines and that they are expecting activity once there is a bit more clarity. But again, they fell back on this sort of message of not really being able to predict the future at this stage.
Yeah, kind of interesting. I am feeling like there's a little momentum, maybe potentially among the financials, that if we get the go-ahead sign, there is a lot of stuff in the pipeline, whether it's M&A, whether it's IPOs, just kind of waiting for that sign that things have calmed down. Sally, thank you so much. So appreciate it. Shares of Citi, by the way, are up about 3%. Sally, of course, is Bloomberg News America's finance team leader. All right, from Citi to B of A we go. B of A also rallying. Kat, come on in on what we got from B of A.
So B of A is also exuding that same confidence that we heard from Citi. Brian Moynihan, in his statement today, he's saying our business clients have been performing well and consumers have shown resilience. They're continuing to spend and they're maintaining healthy credit quality. So it was quite a positive note, but he does then go into the uncertainty that is hard to predict. So there is a note of caution, but I would say that the confidence was louder than the caution this morning.
What's his note of caution specifically?
The level to which you cannot predict the future.
So it's all about uncertainty.
Yes.
And not necessarily about anything that he's seeing.
Yes, but they believe that the strength of, specifically for B of A and for Citi, B of A being the second largest U.S. bank by assets, they have this window into the consumer. A lot of today's call was putting an emphasis on here's where the bank was in 2009 during the financial crisis, and here's where we are today. And they really spent a lot of time comparing the strength that they said they've been working towards over 15 years. And how even if you go into the FICO scores of their consumers, the types of clients and the write-offs or the potential soured loans that they might see from both consumers and from corporates, they say that based on the quality of the actual customers they have, they don't expect to have the same downfall as they once experienced 15 years ago.
So the message is we are more prepared now than we were 15 years ago.
Absolutely. And they are emphasizing that didn't just happen overnight, that they made steps along the way. And
wait, so it's a case of we're choosier about our clients. We make sure who we work with, whether it's corporate, whether it's retail, right? That they're a better level of clients?
I think
they're economically secure level
they're
of
more
clients?
Cautious, and they've changed their metrics over time of the level to which they're able to engage and do business. And
what does that mean, Kat?
Well, if we're talking about FICO scores, yes, they're saying that the concentration of their customer base has changed over time. But when you're talking about the Wall Street businesses, trading, investment banking, those kind of businesses are less about, well, they do due diligence to pick who their customers are and who they're doing business with. But what they're saying is that the strength in the pipeline, what they see coming down the road, that they believe that will continue the strong momentum that they're reporting for this quarter.
So how are you guys thinking about, now that we're kind of done, right? The big banks, right? There's nobody else to
Today
go?
was the last of the 6 big banks, big U.S. banks.
So earnings season off and running. We've been like counting down to this, especially so it gave us something else to talk about in terms of tariffs, but also to get a window into the economy. Sally, is there a message, a narrative from all of them that you felt like was a takeaway? Because it seems like we had a big buyback. Was it out of Goldman? Like, you know, it seemed like they're doing really well. Did it tell us something very significant, or is it just a case the big banks really know how to do their business now?
I think that the line was actually what we wrote about in our earnings, our broader earnings story today, is that whatever they said about uncertainty in the economy, it wasn't necessarily reflected in their actions.
Yeah.
Because they didn't quite put their money where their mouth is in terms of things like share buybacks. They continued those at a pace. And provisions for loan losses, they actually didn't set aside as much as necessarily we potentially expected, which is a sort of a window into their view on the economy. If they don't believe there will be so many soured loans, they don't need to put aside so much money. So those two things that we saw in the first quarter aren't quite necessarily reflective of what the sort of uncertain message that they echoed about the future.
But I do think that's appropriate, given that the first quarter is the activity for the first 3 months of the year.
Right.
And the volatility that we saw in April is not captured. So it's two different tales. I think that the tale significantly changed. The world changed since April 2nd, or really the beginning of April, which is, again, not going to be captured until we start seeing the numbers for the second quarter, for next quarter.
I think that's fair to say. And look, we got the consumer sentiment numbers last Friday that were pretty dismal. And that really went across party lines. It went across different income lines. But Carol, I keep thinking, you know, when we talked to Mike McKee and other folks who follow the consumer, follow what consumers are doing, not what they're saying necessarily. And if these banks are saying they're spending money and they're confident, then, or not the consumers, but the banks are confident, then that's certainly a good takeaway.
I gotta say, I'm a little confused because I feel like there's been some other, you know, data points that talk about rising consumer debt and some other issues. So it's like interesting.
Bank of America said that their charge-offs were roughly flat compared to the fourth quarter.
Yeah.
And I was thinking about, well, what's happening right now? Have you seen a change in behavior even since the first quarter ended of this year?
Right.
And they're actually projecting that based on the metrics they saw for the first 3 months of the year, that the next 3 months, which we will get relatively soon, that they're actually expecting it to be either flat or maybe even down, which was exactly the opposite of what you might think.
Interesting times, to say the least. Kat Doherty and Sally Bakewell, guys, thank you so much. So appreciate it. This is Bloomberg.
3:21 on Wall Street. I'm Amy Morris. Republicans in the White House, the Senate, and the House are all drafting analyses on how to craft a new tax bracket for the wealthiest Americans. The House proposal would set the new rate at 40% for taxpayers earning $1 million or more per year, while the Trump administration is considering a higher threshold. We check markets for you all day long at Bloomberg. The S&P 500 has changed course now, up 2 points. NASDAQ up 10 points. The Dow still down about 50 points. The 10-year Treasury yield at 4.33%. The 2-year yield at 3.84%. President Trump called on China to reach out to him to start negotiations to resolve the escalating trade fight between the U.S. and China. J.P. Morgan CEO Jamie Dimon is urging the U.S. to engage, telling the Financial Times he doesn't think decoupling from China should be the objective, but he also says the U.S. should rely on itself for close allies. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Carol Masser and Tim Stenivek.
It is Bloomberg Business Week. Amy, thanks so much for that update. Do appreciate it. Well, President Donald Trump said on Monday that he's exploring possible temporary exemptions to tariffs on imported vehicles and parts to give auto companies more time to set up U.S. manufacturing. Here's Hyundai Motor Company President and CEO Jose Munoz on Bloomberg TV talking about how he and the company are navigating the scene.
It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by tariffs.
Hyundai Motor Company President and CEO Jose Munoz on Bloomberg TV a little earlier today. For more, let's bring in Keith Naughton. He's Bloomberg News auto reporter. He joins us from Detroit. Keith, I want to kind of go in on Jose's comments there, because what he said is localizing, investing more in the country. And I hear that and I think to myself, the timeline for making an investment at the scale that an auto company would have to make is so long. I mean, we spoke to Magna's CEO last week, who basically said the investments that we're making right now are basically for 2027. Like, these are far out. How are you thinking about it?
Yeah, exactly that way, Tim. It takes about 3 to 4 years to build an auto factory from scratch. Costs about $3 to $4 billion. So if you were to put a shovel in the ground today, the plant probably wouldn't even be up by the time Donald Trump is out of office.
So what's an auto exec to do right now?
Or should I say to say, too?
Yeah, it's very tricky, Carol, because there's so much uncertainty. Even the good news of President Trump yesterday in the Oval saying that he was going to give an unspecified break to auto companies continues to propagate this uncertainty. They need to know what the rules are. One of my sources said to me, this is great, but the devil is in the details. And they don't know those details yet. They need that so that they can plan. Right now, the way things are going, what the analysts are saying is this is going to be a $10 billion cost on GM and Ford each this year.
Wow. That's real money.
So if this stuff stays in effect, could we potentially be at a point where we just might destroy the U.S. auto industry?
That is the concern, Carolyn. We've already hit that first tranche of tariffs, the 25% on fully built cars. The second and far more scary one is May 3rd, when the tariffs hit auto parts. There are tens of thousands of parts in every car. They come from all over the world. So that means that even if you assemble your car in the United States, as Ford does with the F-150 pickup, America's favorite vehicle, assembled in 2 plants in Missouri and Michigan, but with a Canadian engine and parts from all over the world. So that means even the all-American F-150 would be tariffed.
It's pretty remarkable. I mean...
So what would it cost? Maybe.
The cost would be high. I mean, that's the concern. All the analysts say prices will go up anywhere from $4,000 to $20,000 on some EVs.
Yeah.
So how does the outlook shift then for these automakers? How they're thinking about who they're selling to, how much they're selling, and what happens here in the U.S.?
Yeah, so right now they're trying to sell as much as they can because they have pre-tariff inventory in stock. You've seen Ford and Stellantis have come out with these employee prices for everyone discount deals. But that only gets them to, like maybe the beginning of June, if they're lucky. And then there's a great deal of uncertainty. How much of the 25% tariff costs can the companies eat? Their profit margins are single digit, 4 or 5%. And how much can they pass on to the consumer without killing the market? Analysts are saying that sales will drop by more than 1 million units this year because of tariffs.
Okay, Keith, as I mentioned, the president said yesterday that he's exploring possible temporary exemptions to tariffs on imported vehicles and parts. But this would be to give auto companies more time to set up U.S. manufacturing. The details are light on this. But what's the auto industry and what's your reporting telling you about how they interpret comments such as those? Like, is the lobbying that they're doing or the messaging that they're doing getting to the president?
They feel like it is because they've really, as we reported earlier, been intensely lobbying them on an exemption for auto parts. They've even acknowledged it's like, okay, we'll take the 25% on the fully built cars, but you can't hit us on parts or that really breaks the bank. So the comments yesterday, and remember, they come right after he gave some breaks to Apple on iPhones and laptops coming out of China, right? So then the comments yesterday seem to build on this idea that the president is going to be more flexible. How flexible, they don't know yet, but they do have some optimism about what he said yesterday.
I guess we'll just have to wait and see. All right, Keith, always good to just get a gut check from you on what's going on in the latest news, certainly out of Washington when it comes to tariffs on the auto group. Keith, thank you so much. Keith, of course, is Bloomberg News auto reporter joining us from Detroit.
Okay, so that's the big picture when it comes to autos and tariffs. Let's zoom in specifically when it comes to a certain type of electric vehicle. Back with us is Patrick Sullivan, he's CEO at EV Realty. They've got about 7,000 chargers installed. They built 70 supercharger hubs. Their focus is on powering commercial fleets. He joins us once again from San Francisco. Patrick, since we last spoke, you've made an acquisition, Gauge Zero. It's an electric charging infrastructure company. You've got this nonprofit now that you formed. It's a partnership rather with the nonprofit CalStart. But before we get to everything you've been doing for your business, I just want your view on how you believe that tariffs affect your business.
Well, Tim, it's good to be back with you and Carol. And look, Keith and Jose before me said it well. Tariffs are affecting all of our businesses. And obviously, EV Realty is focused on building charging infrastructure primarily for medium and heavy duty trucking fleets. And a lot of those fleets operate out of the Port of LA and Long Beach. And I think Evangelinos works in or is associated with ports and goods movement here in Southern California. And the uncertainty is real. It's real for the ocean shippers bringing containers into LA and Long Beach. It's creating churn for the trucking companies that move it to the warehouses. It's affecting lease rates on warehouse spaces. And obviously, the longer that uncertainty goes, the more you're going to see reduction in consumer habits, and that's going to obviously reduce shipping overall.
President Trump has also halted a $3 billion program, Patrick, to expand the EV charging network in America. And we know those lack of charging stations have really created, along with range anxiety, have really created, the reasons, or at least two big reasons why you don't see a lot of Americans maybe buying EVs here. What can be done to change that?
Well, Carol, it's a good question. And while some of those funds specifically related to light duty public charging stations for passenger vehicles, some of those funds have been paused. A lot of them really haven't. Obviously, EVgo is moving forward at a pretty significant level with their installations. And really more specifically for my business and businesses like them, a lot of the incentive funding really is at the state or the air district or the local level. And the good news is those funds and incentives are very much still there. I think, Carol, one other thing that is probably a good addition to what Keith was previously speaking about around the challenges of tariffs really bringing back manufacturing specifically for automobiles. The good news is with trucks, they're all manufactured here. The Tesla Semi is built in Sparks, Nevada. The Volvo V&R Electric is built in New River Falls, Virginia. PACCAR, which is the Kenworth brand, amongst others, just announced a large battery factory in Mississippi. And so the good news is, despite some of the tariffs, the manufacturing and assembly of the Class 8 electric trucks that we charge really does happen here. It still is a global supply chain, right? The engine could come from Canada or Mexico. The rare earth materials included in the batteries and the magnets are obviously coming from overseas, so there's an impact. But we actually have, similar to the passenger vehicle manufacturing base, there's a really strong domestic manufacturing base for trucks here in the U.S. But still, that uncertainty with the global supply chain will affect those manufacturers.
You know, we talk a lot about EVs in the context of EVs for consumers, and the idea that, you know, for a number of reasons in recent years, Americans are not buying the number of EVs that analysts thought they would. We just spent a good portion of time talking to David Welch about his story and how General Motors has spent billions of dollars in many years working on selling EVs, and how that could be an issue with the drying up of tax credits from the president. That's on the consumer side. On the industrial side, though, do you see the pullback from Washington affecting the industrial business too?
In areas, Tim, yes, but overall, no. And the reason for that is that fundamentally, over sort of the long term, you can both sort of operate and move freight with an electric vehicle at a lower cost than you can moving that same freight with a diesel vehicle. We're working with customers today in California running only electric, winning sort of freight in the spot market and operating those vehicles at a higher margin. So long-winded way of saying that really for industrial and logistics fleets, it comes down to total cost of ownership and operational cost savings. And an electric engine is fundamentally sort of a more efficient engine. And when you're able to use these trucks efficiently, you're actually operating at a better margin over time than if you were running a diesel rig.
Patrick, just real quickly, because we only have got about 25 seconds left here, and to be able to talk with the CEO, these are really important conversations. Do you feel confident about the business environment in the United States, the environment for your company in the for the future? And just really quickly, only got about 20 seconds.
Yeah, Carol, the answer is long-term, absolutely. I think the trends here are inevitable. You see battery costs declining dramatically.
Okay.
As I mentioned, we're seeing customers move freight profitably.
Got it. All right, we're going to leave it on that note. Patrick Sullivan, CEO at EV Realty. He's coming from Los Angeles on this Tuesday. Hey, coming up, we're driving to the close, folks. Got about a half an hour left.
It's 3:40 on Wall Street. I'm Amy Morris. The European Union and the U.S. have made little progress in bridging their trade differences. U.S. officials are indicating now that most U.S. tariffs on the EU will not be removed. And the EU has offered to remove all tariffs on industrial goods, including cars. The U.S. rejected that, instead suggesting some tariffs be offset by increasing investments in exports. The EU has agreed to delay implementing counter tariffs against the U.S. for 90 days, but they say they will impose them if these negotiations don't pan out. Stocks continue to fluctuate between gains and losses, investors not willing to take on too much risk. We do check markets for you all day long at Bloomberg. Back in the red we go. The S&P 500 down 7.5 points. NASDAQ down 21 points. The Dow down 115 points. The 10-year Treasury yield at 4.33% and the 2-year yield at 3.84%. Hyundai expects car prices to remain relatively steady over the coming months despite added costs from the escalating global trade war. Automakers trying to maintain stability and keep customers coming to their lots. President and CEO Jose Munoz on at navigating President Trump's tariff rollout.
It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by tariffs.
Jose Munoz speaking with Bloomberg TV. Hyundai shares now more than 4% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we are coming up on just about 17 and a half minutes to go until we wrap up the trade on this Tuesday, and we're definitely off the best levels of the session, just a little bit lower on the S&P 500, down about 0.1%. The Dow Jones Industrial Average down 132 points, a decline of 1/3 of 1 percentage point. And the NASDAQ 100 just up 0.1 of 1%. That's good for a gain of about 18 points. Dig into the S&P 500. And folks, you do see a little bit more to the downside. Risk off, 294 names lower in today's session, 208 to the upside, 1 unchanged.
The S&P 500 has not recovered everything from the shock that it experienced the day after April 2nd, that Trump referred to Liberation Day. So I'm wondering what Alan Zafran has to say about the mild recovery that we've seen, and if he's changing investor portfolios, making new investments, changing asset allocations. Alan's founding partner and co-CEO at IEQ Capital. He joins us from the Bay Area. Alan, good as always to have you with us. I think a lot of investors, and certainly no question the market was caught off guard earlier this month. Are you changing asset allocations as a result of Trump's tariff policies?
Tim and Carol, thanks for again having me on your show. The quick answer to your question is no, we're sticking with people's long-term asset allocations. However, for those individuals that either have a greater degree of risk tolerance with a long-term time horizon or aiming to be modestly opportunistic, if and as prices fall enough, we're beginning to encourage people to think about dollar cost averaging into equity prices as they fall, or where you get unique situations like in the municipal bond market, where we've seen such a dramatic drop in price. We're actually encouraging people to take a look now at investment grade, high quality municipal bonds as part of a well-diversified portfolio set. So the answer is the big picture, don't change your long-term objective. Yes.
Well, and that's what I want to ask you, Alan. What gives you the confidence to think about that going forward? I can't tell you how many guests come in and we talk, and on air or sometimes off air are saying we could be at a moment in time where the U.S. economy and the role of the United States in the global financial system is being changed forever, and the biggest change in our lifetimes. And so if that's the case, if dollar-denominated assets aren't so important going forward, if the U.S. dollar doesn't reign supreme, that could change things dramatically. So if that's the case, and if our global trading partners look elsewhere and the world looks different, for other assets other than US-based assets, that would be a very dramatic change. And I'm not, so if that's the case, why is it going to be okay in the long term, in your view? Or maybe you don't buy that case.
Well, I don't buy that case entirely. I think U.S. exceptionalism is still a valid claim, albeit on the margin, you can argue that other countries' companies may become relatively greater beneficiaries from a change in the currency relationship that transposes. What we're arguing is you should have holdings that serve well in a variety of economic outcomes. That would include the notion of potentially owning non-U.S. denominated assets or simply owning non-U.S. stocks as part of a well-diversified portfolio. The reality is the vast preponderance of our clients are U.S.-centric clients. They spend and live in U.S. dollars, albeit they have a modest amount of non-dollar exposure in their purchases when you buy foreign goods and services. That's actually earned by owning companies that are multinational companies that generate the profits that come back to you by operating in foreign countries. And there's not a problem with having a well-diversified portfolio that on the margin will add those other assets. But to claim that suddenly the U.S. capitalist system is completely broken and will fall apart seems to be very extremist in our opinion. And really the aim of a well-diversified portfolio is to grow at a moderate pace in excess of inflation with respect to your risk tolerance. So when an asset class like tax-exempt bonds trade at the highest level they trade at in 15 years because the client base of municipal bonds, retail investors are selling their bonds to create liquidity and a panic from the stock market, you're getting very attractive risk-adjusted returns. So just to pick on investment-grade municipal bonds, depending on what state of residence you're in anywhere from 3.5% to 4.25% state and federal tax-free, which is equivalent if you're in the highest tax bracket of 7 to 8.5% as a diversifier against some of the other riskier assets you're now going to look and step into. So we can debate the merits of having non-U.S. assets, but also if you're a U.S.-centric investor spending most of your capital in U.S. dollars, you need to make sure that you're taking advantage of price dislocations when there's an excessive level of panic, which we are still amidst today with the VIX elevated at its level, with consumer confidence down at a very low reading we haven't seen since the 1950s. It feels as if the panic is a little bit greater than the fundamental changes that are swirling in the global economy.
Why are you so confident that we won't see a fundamental reorganization of the global economic order?
I think you are witnessing the beginnings of a reorganization to a degree, but let's put it in context. A world in which you have 10% baseline tariffs and maybe the average tariff rate with China is 14%, puts the U.S. in a slower growing environment with moderately higher inflation, but it doesn't put the U.S. in a recession. It misallocates resources where they might otherwise go a bit, but it still allows for global trade. And so there's a world in which stocks can still grow earnings, technology companies that are not as economically sensitive to some of these political and economic gyrations will still flourish. And as a relative benefit, those that are sitting with the highest quality businesses that are continuing to generate positive cash flows despite whatever the tariff rules might be are still going to be perfectly fine as part of a well-diversified portfolio. So our view is don't throw away basic asset allocation fundamentals for the sake of headlines. There's still a large degree of uncertainty, but there isn't a lot of certainty yet that the world's going to completely change. So oftentimes when we face challenging times, the best thing to do is stay with your long-term course or further diversify to mitigate the likelihood they have too much in any one thing that if things go wrong, you'll obliterate a good portion of your capital. That's what we're aiming to avoid.
All right, interesting stuff. Alan, thank you so much. Alan Zafran, he's founding partner and co-CEO at IEQ Capital, joining us from the Bay Area on this Tuesday afternoon. Folks, we've got just about 10 minutes to go until we wrap up the trading day on this Tuesday, April 15th. Pretty much near our lows of the session, certainly on the Dow. The S&P, again, little change, just down about 0.2%, down 11 points. NASDAQ 100, call it pretty much flat on a percentage basis, just up about 6 points. Got some earnings coming up, including United Airlines, all to come right here on Bloomberg.
You're listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody, we're just about 7 minutes away from the closing bell on this Tuesday, April 15th. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Broker studio. Heading over to our TV colleagues in just a moment. We'll count you down to the close, also walk through some of the earnings after the closing bell, including United Airlines. That'll be a big one because we know that there's been some cautiousness, certainly within the airline industry. We had Delta and American about a month ago, right, talking down their outlook. So we'll see what we get from United. Having said that, what is on your radar, Mr. Stenovec?
Here's an interesting one.
Yeah.
There's a lot of interesting stories. Elizabeth put a couple in there.
I know where you're going. Where are you going?
I'm going taxes.
Oh, good. I'm glad you're going there.
This is the most read story in the last 8 hours.
I think this is wild. It's an exclusive, too, isn't it?
It's a Bloomberg exclusive. Nancy Cook, Saleha Mosen, and Eric Wasson are reporting that Republicans in the White House, Senate, and House are drafting analyses on how best to craft a new tax bracket for the wealthiest Americans. It's a signal that the GOP under President Donald Trump is seriously considering ideas that raise taxes on the rich. What? Excuse me?
Wait, okay. Sit down, everybody. Make sure you're sitting. House proposal setting a 40% rate for those earning $1 million or more a year. So that's on income, so not on investments?
Yeah, that would be income.
Okay.
If you have to ask, Carol.
No, but...
then it doesn't affect you. Sorry, I don't know.
No, but it's interesting because this has always been, this is why people have talked about wealth taxes and so on and so forth, because so many of the super uber wealthy, right? It's not about income, it's about their investments.
Hold on, but how does it work? Is it a new top tax bracket?
I don't know.
Okay, so a White House official speaking on the condition of anonymity to discuss private conversations said Trump is open to the idea of a new top tax bracket. However, the person emphasized that the higher rate should kick in at a threshold far greater than $1 million. So just a reminder about how, again, it's tax day. I'm not an accountant.
Somebody's done their tax homework,
but my understanding of taxes is that higher tax rate will kick in at income above.
Right.
Am
So
I right about that? So it's not like your whole income's not getting taxed at 40%.
No, it's not like you would lose 40% of that $1 million. I don't
Exactly.
think
It's like
so.
That's my understanding.
Right.
That's my understanding.
Yeah. Yeah,
Okay.
that's what
Is
it
that
seems
right?
like. Yeah. Let's see. Treasury Secretary Scott Bessent said in an interview yesterday with Bloomberg News, or Anne-Marie Hordern, that everything is on the table with regards to the tax bill. So we shall see. The discussions about a new tax bracket for millionaires come as Republicans are looking for ways to pay for a sweeping tax bill by the end of 2025, when several of Trump's first-term cuts expire. The current top tax rate is 37% for individuals earning more than $626,350 a year. So I don't know that that's such a big deal.
Why?
It's already 37% for people who earn about $360,000 a year.
No, $626,000 a year.
Oh, 600. I'm
Yeah.
sorry. Did I say? Yeah. Okay, 626. So I'm just saying it bumps it up another $300,000. Would be 40%.
But that would only kick in at $1 million. So now the top tax bracket doesn't go up to $1 million. So it would ostensibly shield the people who earn up to $1 million a year from that top tax bracket.
So that
Does
would
that
make
sense?
it the top. Yeah, I guess so.
So that would make it the top tax bracket.
Yeah.
I think a lot of people out there are also wondering what happens with SALT, because high rates on top earners could be a way to offset the cost of an expanded SALT deduction. It's a popular and politically important tax break for swing district Republicans in New York, New Jersey, and California. Remember, that SALT deduction limit was put in back in 2017 as a result of the 2017 tax bill from the president.
And some might say, it's the corporate tax rate you need to look at. They currently pay 21%. President Trump reduced that from 35% during his first term. That's a big haircut, 14 percentage points. So there's a lot to play around with. We'll see what happens in Congress, right? I mean, Republicans, even if it's a thin, narrow majority, they are still in control.
Senator Tom Tillis, a North Carolina Republican, said Congress should put in limits on a top tax bracket to reduce levies on those privately held companies, because if you raise the top tax rate, you get some backlash from business owners, partnerships, LLCs, and people who have pass-through entities.
How about a flat tax against everybody?
I have no idea.
Get rid of exemptions.
No idea.
Boom. Just
to be a big difference from what Republicans have done in the past.
We'll see what happens. Let the tax talks begin. All right, do not go anywhere. Right now, the closing bell starts.
global simulcast. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu, taking you through that closing bell, a global simulcast. It starts right now. Carol Massar, Tim Stenovic, they're in the radio booth. They join us as they do every day at this time as we welcome our audiences across all of our Bloomberg platforms. Another low volume day, Carol Massar here, about 27% below where we would normally be in terms of volume. And the net effect of it all is an S&P that's relatively unchanged.
Yeah, it feels kind of anemic, right, in terms of the trade, really, really kind of mellow. But we are off our best levels of the session. However, take a look at the big banks. Thank you, Bank of America and Citi, because you've got the KBW Bank Index up about 1.2%. So some outperformance certainly in that group.
Not a lot of conviction in today's trade, at least according to the S&P 500. We did see it move between gains and losses just a little fewer than a dozen times today, but really hovering at that unchanged portion for some of the day around 1 o'clock.
It definitely feels like everyone's waiting for another shoe to drop, but they need to wait a few more weeks before it does, certainly until the end of this week, because there's not a whole lot going on, right? You have Jay Powell speaking, and so maybe people are holding off until then.
Good point.
And you also have a holiday shortened week and, you know, waiting for more people to come in, waiting for more earnings to come in for companies to say that they have no visibility.
I do wonder if the shoe that is going to drop, Scarlett, is it domestically produced or would that shoe be imported?
And we talk about earnings too. We are going to get some earnings after the bell, including out of United Airlines, J.B. Hunt, the big trucking company, as well as Omnicom, of course, a big advertising agency. So we'll get a little bit of a cross section here of economic conditions. Just want to point out too, headline crossing the Bloomberg terminal, a huge drop today in the Swiss franc. Remember, that had been a huge part of a lot of that disruptive trade that we saw last week when it came to the dollar, as well as treasuries here, a 1% drop on the Swiss franc relative to the dollar on the day. Meanwhile, the majority of the S&P stocks are in the red, but the net effect of it relatively unchanged. A loss of about 9 points or 0.2% on the benchmark index. The Dow Jones Industrial Average down 156 points or 0.4%. The NASDAQ unchanged on the day, and Scarlett, the Russell 2000 coming in on the day here with a drop of roughly about I take that back. A gain of about 0.1%.
Okay, so pretty muted moves there for the major indexes. Let's get you some earnings that just crossed. United Airlines reporting first quarter adjusted EPS of 91 cents, beating the consensus estimate of 74 cents. United also sees its second quarter adjusted EPS of $3.25 to $4.25. So that's a $1 band. Analysts were looking for somewhere in the neighborhood of $3.97. So it's a little bit all over the place when it comes to second quarter adjusted EPS. For the full year, it has maintained its forecast. It still sees anywhere from $11.50 to $13.50 if bookings are stable. And of course, that's a big if because we don't know what the situation is when it comes to tariffs and uncertainty. And as a result, United provides two full-year adjusted EPS scenarios amid all this uncertainty.
Can I just say, United provides two fiscal year adjusted EPS scenarios and uncertainty. I can't even remember the last time I've really seen a company do that, but I know.
Yeah, I mean, it's at least they provided something though here, so maybe that gives investors something to hang their hats on.
Amazing.
Meanwhile, Interactive Brokers reporting results as they crosses the wire right now. The company's first quarter adjusted net revenue coming in line with estimates at about 1.4 billion. Net interest income a slight miss at 770 million. The street was looking for roughly 794 million dollars. The company also saying that its total customer accounts did tick up just ever so slightly. 3.62 million. Street was looking for 3.61. We're going to dive a little bit deeper and see if there's any forecast. Not jumping out at the moment. Shares unchanged in the after-hour session.
Okay, let's go back to United Airlines. Shares higher by about 2.4% in the after hours. As Carol mentioned, the company did provide two fiscal year adjusted EPS scenarios amid uncertainty. The company sees second quarter adjusted EPS $3.25 to $4.25. The estimate was for $3.97. United still sees fiscal year adjusted EPS $11.50 to $13.50 if bookings remain stable. Sees fiscal year adjusted EPS in recessionary scenario $7 to $9. So a big cut if there were a recession again, United coming out with 2 different fiscal year adjusted EPS scenarios amid uncertainty.
All right, guys.
But just that point, though, too, because I'm trying to remember the last time I saw a major company give that type of range. I mean, this is kind of what analysts do on Wall Street. You know, they kind of give the bull case and the bear case. But it gets to this idea. We've had a few CEOs on this program and CFOs talking about this idea. They were reticent to give guidance, primarily because, you know, A, they didn't want to get sued, but also just this idea of how do you even know?
So what do? You hedge your bets and say, listen, if this happens, here's what could happen for us, and if this happens, here's what else could happen. I mean, I can't remember the last time I've ever kind of seen that from a company. So pretty interesting.
It feels like investors like it, though, given that the stock is higher in after hours trading, and it's a little more honest than to say we have no visibility, we don't know, we're going to keep our guidance, but it'll exclude the impact of tariffs. They're saying, you know, here's how we're thinking through everything.
And I will say that they are pulling in their fiscal year adjusted capex below $6.5 billion. They had seen up to $7 billion. The street estimate was $6.7 billion. So this again speaks to maybe pulling in a little bit in terms of their spending.
I briefly want to jump in with Omnicom, the advertising, marketing, communications company. Shares in the after hours are unchanged. The company did report first quarter revenue that came in pretty much in line with estimates at $3.69 billion. First quarter adjusted earnings per share coming in above estimates at $1.70.
And I'm kind of curious, too. I mean, obviously, Omnicom itself, of course, isn't necessarily a barn burner of a stock, but don't forget we get Netflix in a couple of days, and it'll be interesting. And, of course, with that new ad tier, it'll be interesting to see how they fare during the time, and particularly going forward with, if they do offer guidance, going forward, sort of what that ad tier actually looks like, particularly if you do think that we are headed towards some sort of economic softness.
I wonder if United, by giving 2 scenarios, gives permission for everyone else to therefore give different scenarios in their earnings outlook as well. You open the floodgates and now everyone can say, okay, here's what it looks like if things go on as normal. Here's what it looks like if we dip into recession.
Because it was big news last week when Delta essentially pulled its guidance and said there was too much uncertainty. We can't tell you what we think we're going to do because we have no idea. Do then other companies come back and say, okay, wait a second, we can provide these 2 different scenarios. Here's what we're thinking if there's a recession or if there's a slowdown, and here's what we're thinking if things go undisturbed.
I agree with you, though, Scarlett. Investors giving them props. I mean, you got United Airlines up about 4.8% here in the after hours. So maybe investors saying thanks for giving us and laying it out for us. American Airlines, folks, I just want to point out, also up about 1.6%. Delta's up about 2.4%. JetBlue up about 0.8%. So we're seeing the whole group being lifted. I know you've got some earnings there, Romaine.
Yeah, J.B. Hunt, the trucking company, out with its first quarter EPS numbers, $1.17. That's what's coming in. That beats street estimates. On average, they were looking for $1.15. Revenue, $2.92 billion, a slight beat as well over the average of analyst estimates, and the company saying that its dedicated revenue at $822 million. That's actually a little bit of a slight miss. Nevertheless, the share's up by about 1.4% here in the after hours trade. And the big question I have going into that conference call isn't so much about guidance, but this idea here as whether this company is in the moment a beneficiary here of some of that pull forward that we seem to be talking about anecdotally with regards to consumers trying to get their hands on everything they can before the tariffs kick in.
And how long does that pull forward last? We saw that certainly at the end of the first quarter, and we're definitely seeing it at the start of the second quarter. But now that you have this 90-day reprieve on most of the tariffs, does that continue until we get a final word on the tariffs?
Hey, I'm just going through United's statement to try to get more color and clarity on these 2 different outlooks. The company did say this is a challenging macroeconomic environment. They also said they're removing 4 percentage points of scheduled domestic capacity in response to the current demand environment. They're going to do that starting in the 3rd quarter of 2025. They're also saying they're going to make prudent adjustments to the utilization rate of its fleets, including ongoing reductions of off-peak flying on lower demand days. They expect to continue this approach into the 4th quarter of 2025, and they're going to retire 21 aircraft earlier than previously planned. That part they had announced previously.
Listen, we said that these earnings were all going to be important. We're just getting going. But, I mean, they're laying it out. They're kind of saying that, yeah, there's uncertainty, but here's how it could go if we see kind of a change, maybe when it comes to tariffs in the economic environment. Good news versus maybe not so good news. I mean, I'm looking at United, mind you, they've been hammered this year, like a lot of the airlines. It's still up about 4.5%. I feel like the earnings analyst call is going to be really crucial because I feel like analysts are going to push them, even further. Like, which scenario is more likely, the bad one or the better one?
Yeah, but then that sort of requires them to be kind of like, economic, strategists, macro strategists, if if you will. I'm sure it's something that they'd rather avoid doing. But it gets to this idea, too, as to who is now making that call, right? Because this really goes beyond the purview of what the normal job duties would be of your CFO and certainly of the CEO, him or herself. So the question is, who do they have on staff there who is kind of the economic whisperer, if you will?
Yeah, it's a good point. Also a good point is the idea that they're giving two scenarios, but there could be any number of scenarios. So it could be countless scenarios, but at least by giving two extreme scenarios, it kind of resets expectations in terms of it could be anywhere from here to here, and we'll just see how it goes. Worth noting as well that Delta and American Airlines shares are following United higher in after-hours trade.
I was just on a United plane.
Yeah?
Yeah.
How'd that go?
How was the meal?
I made it back.
How was the meal? Shake Shack burger?
No, there were no Shake Shack.
Oh, you were in the back of the plane, right?
Yeah, sure.
Did you get peanuts and a pillow at least? Only kidding.
Twisting that knife a little bit
I
there.
see how he flies. He's in the front of the plane. All right, that's a wrap. Our cross-platform coverage. Earnings just getting started, folks. But we're going to wrap it up on this Tuesday on radio, TV, YouTube, Bloomberg Originals. Be sure to catch us same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Business Week. That is Carol Masser. I'm Tim Stenivek. Bloomberg Business Week Daily here in our Bloomberg Interactive Brokers studio. A week ago today, Carol, Bitcoin reached its lowest level of the year in the neighborhood of $77,000. Since then, it's up about 10% more or less, as we've seen other risk assets rally in the wake of the tariff pause. Right now, Bitcoin's at $84,000. I'm curious how Stephen McClurg has been watching this. He's CEO of Canary Capital. It's an asset manager focused on crypto. It's got about $300 million in assets under management. He joins us here in the Bloomberg Interactive Brokers studio. Stephen, good to see you. Thanks for joining us. You know, when we talk crypto, we don't often talk about trade and tariff policy. But given the way that we saw these assets sell off, when we saw the risk off, well, I can't even say it was risk off because look at what happened in the bond market. We can't even say that.
Yeah.
It was kind of like a sell everything event. You know, it's puzzling to me. I guess puzzling to me why we'd see this asset class move in an environment where it's supposed to kind of be not correlate with other asset classes.
Yeah, well, thanks again for having me, Tim and Carol back. This is it's always great to be on your show. Bitcoin and other cryptocurrencies will follow risk assets most of the time. It's really how investors view the asset at the time, that when there's big shocks like the tariffs, which really caused waves across global equities and crypto and bonds, sell everything, like you said. But what I expect to happen, Scott Bessant came on, I think yesterday.
Yeah, he was on yesterday.
Yeah, and and was talking about how we've probably really peaked out. And I agree with him. We've really peaked on the shock and the scare that has come with tariffs. And now I do expect a divergence from other risk assets and crypto going forward. And that probably has more to do with the money printer. And money printing will really cause all boats to float. Everything will go up, but equities will probably still be dragged down by tariffs all year, despite the money printing beginning to happen.
It's just funny. We're coming off of United earnings, and they basically laid out two different scenarios in terms of their outlook. And one of the scenarios sees fiscal year adjusted EPS in recessionary scenario, and it lays it out. Are you laying out multiple scenarios for the rest of 2025?
I really am. I don't believe the U.S. will go into recession in 2025, but 2026 is very highly likely on the table. We're seeing a global recession, and it has been forming over the last 3 years. Well, first of all, you have China. China's built so many cities that don't have people in them. They're producing goods that nobody wants, and China's technically been in a recession for the last 3 years. So is Germany. UK's had issues. So we're seeing a global recession across the board. The U.S. has held in, and some other countries have held in, but...
Why do you think the U.S. holds up until 2026? Why do you think it happens here sooner?
Well, there is a scenario where the U.S. goes into recession in 2025. I just think the odds are very low. But there is so much. There's a lot of fanfare around Trump becoming president, lowering taxes. We're going to have likely going to see a bill that lowers corporate taxes even further. We probably see a SALT increase. We likely see decrease across the board, except for people making over $1 million. But we will see tax cuts across the board in the U.S., which will probably keep the economy going through at least 2025 and maybe a little bit into 2026 as well.
If I'm trying to
You're speechless, Carol.
I am a little speechless. First of all, I'm like the SALT going up higher. I mean, how do we pay for things? How do we fiscally pay for things?
Use
it just
Bitcoin,
seems like,
Carol.
I mean, how can you reduce the corporate tax rate?
I don't know how it's going to happen. I'll be honest. Tariffs are supposed to pay for some things. Higher taxes on people making over $1 million is going to not even put a dent in it, because if you're making over $1 million, then you can afford great lawyers and accountants that will actually figure out how to reduce your tax rate. I had a really, under the first Trump presidency, his Treasury Secretary, I happened to bump into him at a Dodger game, and we were talking about.
Are you talking Mnuchin?
Yeah,
Stephen Mnuchin.
And we were talking at a Dodger game with it was Steve and I and Scott Minerd, and we were talking about how
of Guggenheim formerly.
Yeah, I used to work for Scott.
Yeah, we've talked to him a lot.
The late great Scott. Yeah. And we were just talking about, okay, well, how's this? What are people supposed to do in an environment where taxes are coming down, corporate taxes are coming down, but it seems like other taxes are going up for wealthier people, and
or individuals, especially like if you live in a state like in the Northeast, and where your state and local taxes are pretty high.
Yeah, and his answer was really funny. So here's what Steve said. He goes, "We should just incorporate yourself." And you're just looking at each other like, well, that's what everybody does that makes over $1 million. They just incorporate themselves and they get a lower rate. So, now, does that help pay for anything?
But if you work
that's what the article said, basically, is, there's going to be pushback on this and what happens to S corps and, LLCs and pass-through entities such as those.
Yeah.
You have confidence in this administration that things are going to work out? I mean, one of the concerns is that as we push back on globalization and relationships with former trading partners, that maybe we end up ultimately getting squeezed out of whatever is the next financial services system, next great thing, where China, many would argue, is already leap years ahead of us in terms of some of their apps and so on. So you work in the space where digital crypto coins are considered to be part of that next leg. So might we be setting up where the U.S. is kind of squeezed out, potentially?
Well, I believe the U.S. has already reached the breaking point, and there was already a move to push.
A good breaking point or a bad one?
A bad breaking point for the dollar. And there was already a move over the last 10 years to push U.S. out as a global reserve, mostly by China, and the creation of the digital renminbi. And that's been going on. That's been going on for a long time.
But how's it going?
It's getting there. I mean, it's getting there.
Most of the world still transacts in dollars.
That's exactly right. But the peak is when we weaponized SWIFT against Russia. At that point in time, then Russia said, well, why do I need dollars?
Hey, before we let you go, we haven't spoken with you since we've seen the Trump administration make moves with a strategic Bitcoin reserve and have that crypto roundtable. Crypto czar and AI czar David Sachs is in the position now. There's also this notion that the Trump family is getting really into crypto, and some reporting that we had from our team shows that, at least in paper wealth this week, they've made $1 billion in so many different aspects. Are you concerned about the Trump family involvement in crypto?
I'm really not. It's like any other administration or any other politician out there. Their family members are going to make money where they see
this is not moving. Like, a peanut farm with
right.
Jimmy Carter. I think it's fair to say.
Yeah, that's
not like
absolutely right.
Yeah,
it doesn't concern me, but it actually makes me want to buy more crypto because
because conflict. I mean, if they're in, obviously, many would say that they're going to continue to do favorable things for the overall crypto market.
They know something. They know something.
Doesn't that make you uncomfortable?
You know,
and forgive us, we've just got about 30 seconds.
Yeah. Well, I think the difference between the Trump administration and a lot of other administrations is they're very open about what they do. And a lot of other people aren't open about what they do.
And to be fair,
so you know.
and to be fair, there's a lot of things that happen with members of Congress and so on and so forth.
I will say I did ask Eric Trump a few weeks ago about conflicts of interest. He said there are not any, and that he doesn't talk to his dad about crypto.
Wish we had more time. Stephen, thank you.
I wish we too.
Yeah. Come back soon. Stephen McClurg, CEO of Canary Capital. Coming up next, we dive into higher education. This is Bloomberg.
It's 4:21 on Wall Street. I'm Amy Morris. United Airlines offered two profit scenarios, one reiterating previous guidance if the environment remains stable, the other predicting lower earnings if revenue worsens. Shares of United Airlines now up 6% in the post-market. And of course, we bring into closing numbers each day here at Bloomberg. The S&P loses 9 points, NASDAQ down 8 points, and the Dow down 156 points. The 10-year Treasury yield at 4.33% and the 2-year Treasury yield at 3.84%. President Trump calling on China to reach out to him to start negotiations to resolve the escalating trade fight between the U.S. and China. J.P. Morgan CEO Jamie Dimon urging the U.S. to engage with China, telling the Financial Times he does not think decoupling from China should be the objective, but that the U.S. should rely on itself or its allies. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenivek.
Amy, thanks for that. Do appreciate it. We are going all in on higher education right now because there is a lot happening when it comes to Washington and elite colleges and universities. President Trump escalating his administration's fight with Harvard by threatening its tax-exempt status after the school defied the government's demands to change its policies in exchange for billions of dollars in federal funding. Also, that's not all. You'll recall that a bit less than a month ago, the president said that the Education Department's $1.6 trillion student loan portfolio would be handled by the SBA. That move coming amid worries that his efforts to overhaul the federal government could reduce programs and services. So we've got a great pair of voices to talk about higher ed. Janet Lauren is higher education finance reporter for Bloomberg News. Jillian Berman is here too. She's assistant managing editor for News and Enterprise at MarketWatch. She's also the author of a brand new book. It's out now, Sunk Cost: Who's to Blame for the Nation's Broken Student Loan System and How to Fix It. They both join us here in the Bloomberg Interactive Brokers studio. Janet, I do want to start with you in Harvard because I think it's fair to say shots fired.
Yes, for sure. Yesterday, Harvard released a letter that was sent to it last Friday by the government, by a multi-agency task force, sort of stepping up their demands if they want to continue their flow of billions of dollars in federal research funding. They released that letter along with one from two law firms saying they were not going to accept their demands, and said there were certain lines that they could not cross in terms of academic freedom. They had a whole list of things such as the government wanted curbs on doing things in admissions and governance and hiring and lots of things, and they said no. And a couple of hours later, the federal government said we're freezing $2.2 billion in loans. I'm sorry, in grants.
It's a big deal.
It's a big deal, and it's a lot of money. And you say, well, but they have a $53 billion endowment. Why can't they spend it? Well, 70% of it is restricted, and it isn't a bank account, but certainly, you know, they have some liquidity. You know, they have a $1.5 billion line of credit. We saw last week they issued bonds of $750 million, but it is a lot of money because 11% of their entire budget comes from the federal government in these research grants.
I got to say, when we talk higher education, there's just a lot of money either way you look at it. Now, someone like Harvard has a huge endowment, which gives it an incredible cushion. Having said that, I want to pull out a little bit and talk about the money that is in higher education. We all remember, is it 10, 15 years ago, that headline that came across that said college debt was higher than credit card debt. And we all stopped and be like, how did we get here? Jillian, come on in on that side of the story. This is what you get into, because I think we spend so much time, how did we get to this point? How did we?
Yeah, so, you know, there are several different factors, but that headline you talked about really came in the wake of the Great Recession, and that was a huge moment for the explosion in student debt. We saw states pull back from funding their public colleges, which means students and families had to take on more of that funding. Obviously, families didn't have as much money to tap themselves or equity in their homes. And then also because of the, you know, the sort of loose labor market, students who graduated with this debt had trouble finding jobs that could help them repay it. So the Great Recession was, you know, sort of a really big moment for student debt.
It's a unique problem to the U.S., though. And this is something that doesn't happen in other countries. But at the same time, we also have the best, one could say, we have among the best universities in the world. Not every one of them, but certainly these are institutions that are recognized internationally. What is so different about the U.S. system that allows something like this to happen?
Yeah, so the way that we fund colleges in the U.S. is largely through students. So, you know, it's sort of like a voucher. The student decides where they want to take that government money. In a lot of other countries where, you know, we think about having little student debt, the government is doing more direct funding of the schools themselves. And, you know, that design of the system here in the U.S., that was on purpose. We like to have, you know, what we call like diversity of institutions and, you know, sort of the ability for the market to play out.
So, in the Trump administration has said they're interested in, of course, shutting down the education department, which after 2009 began dispersing the loans. And now we're at a huge amount. I think it would be the 5th largest U.S. bank in America. Is moving it away from the education department to another agency, Trump has said a small business SBA, would that be reasonable?
Depends who you ask. I think, the way, there hasn't been much detail, first of all, about that plan, but I think the way that they envision it is, maybe moving some of the staff at the Department of Education that handles this stuff over to SBA. Even still, I think people who work on these things are worried that it could cause a lot of disruption. We already have some evidence that the staff cuts have caused disruption for borrowers and for students as they try to access those funds. So I think it could pose some challenges.
I kind of approach this differently now that I have kids, because now I need to save for college.
It's going to cost you $1 million a year.
Well, that's just what I'm wondering. I mean, everybody sitting around here does have to think about.
It's funny, but not funny.
You're done, Carol.
I know, but
you're not done yet.
No, I'm not done yet, because there's, we're also in an environment where it's like, okay, now go get the master's.
But when I was in college, it was like, okay, in the $20,000 to $30,000 per year. Now we're at what, Carol? Roughly?
60, 70, 80,
90,
plus.
90, everything all in, the total cost of attendance.
Yeah.
I was thinking then it couldn't get any more expensive, Jillian, but that obviously wasn't the case. The system has to break at some point, no?
Yeah, I mean, people keep saying that, and we'll see. I think that some of the disruption, caused by the cuts at the Department of Education may, push some things in another direction. Also, a lot of people have done some reporting on how Gen Z is really less interested in college, and so, that could put some enrollment pressure on these schools and force them to bring down the cost.
How much fault do you put at universities and colleges where the price just seems to go up and up and up, and they're like, we've got to pay because it's for teachers, it's for facilities,
Deans,
XYZ, yeah.
Deans and food.
Like, how
nice
is it that
dorms.
it has outpaced inflation many times over?
Yeah, I mean, I think the argument that I take in the book is that in a lot of cases, the colleges are sort of like responding to incentives created by the system. So, I mean, one big example is if you talk about graduate school in the mid-2000s, the government allowed for people to start borrowing up to the cost of attendance for graduate school. And then kind of shortly after that, the number of master's degree programs exploded at universities. And
there's a financial pipeline.
Right, exactly. Yeah. And at the time, even Republican lawmakers, didn't really think that much about the consequences of that decision, and if you were to ask them now, that would be a no-go.
What about loan limits? Are those have been talked about? Certainly they're in place for undergraduates, but for graduate students, instead of up to the cost of attendance, what do you think would happen there?
So that, I think, some congressional Republicans are interested in doing something like that. I think in a lot of ways it makes sense. And then, of course, there's other people who will tell you, well, if that happens, then you're going to be sending people to the private market where, often there are fewer protections. So it's like a tricky balance.
Or not as many will go to school.
Right, or not as many will go to school.
Which some have argued, we all laugh about it, but it's not funny. But, you need a plumber, an electrician, or somebody in the construction industry. There's, you're fighting for these people. And they all talk about it, that there's nobody there to do these things. And whether or not we go back to tradespeople. I know that's another argument.
Right, exactly, yeah.
So, Jillian, we talk about this in the context of what's happening in Washington right now. And a lot has changed in this administration. And we're at a point where I think it's fair to say that the Trump administration is in a combative stance with colleges and universities right now. How do you look at what's happening in Washington as really reshaping higher education in the U.S.?
Yeah, I mean, I think, part of the reason that there's been some political will for the kind of stuff that the Trump administration is doing is because of questions around the value of higher ed. If people thought that they were getting their money's worth, it would be harder to attack these institutions. So, I think it will raise some questions about, about that going forward.
In your view, Janet, is it realistic to think that in an institution like Harvard, for example, could lose its tax-exempt status?
It's hard to predict anything these days.
What would it do to an institution like Harvard?
So Harvard doesn't pay property taxes. I mean, unless it's a business expense, like if they run a parking garage, they would pay taxes. They're able to issue tax-exempt bonds. They do pay an endowment tax as of 2017. Their donors get a tax break. If you give money to Harvard, you get a tax break. So there's a lot of things, and especially going to the bond market, they just had taxable debt, but they do have the ability to have tax exempt debt.
So, Jillian, where do you see this going, right? Because it just feels like the velocity continues, the debt continues to grow, it continues to be a story we, talk about, and it really is difficult on a younger generation who want to buy homes perhaps and have families, but they're stuck paying off their college loans, and that has an economic impact.
Unfortunately, it seems like we may be stuck in the pattern that we're in for a while. There's not a lot of political will to change the system. The people who have the power to do it really are Congress. And, part of the reason why we've had so many changes in policy and borrowers experience so much whiplash is because the executive branch has tried to do it, but, they only have so much power, so it just gets reversed the next time.
Do you anticipate that more kids might go outside the United States for college and that could at some point have an impact?
Oh, interesting. I don't know. That's definitely often advocated as a cheaper option. So we'll see.
Yeah.
I was talking though to somebody recently, and even the schools outside the U.S. aren't even that much less expensive at this point.
I was going to say,
then you got to pay for them to get overseas on a plane ticket.
Yeah.
Sounds like you've been thinking about this, Janet. Hey, Jillian, before we let you go, if we're talking in 5 years, do you think this problem will have gotten better or gotten worse?
Will there be sunk cost part 2?
I think maybe, unfortunately, the way it's looking, not better necessarily.
Glass is not half full in any way.
Glasses, I guess, you know what, there have been some states that have, really tried to invest more in helping their residents go to college. And we actually have seen evidence that the cost of public college on average is going down a little bit. So it's unclear if that trend's going to continue, but maybe it will.
I remember, was it Bloomberg who did the survey, and they said, or was it Jared Dillian? I don't know. It was either unless it's Harvard or an Ivy League, that state schools increasingly.
That's Jared's view, basically.
You get more bang for your buck in terms of, but I thought we did some research too.
I think you guys, had a good piece about, sort of the value of a lot of different public colleges.
The ROI, the return on investment, right? And in terms of so maybe, people start to think more closely.
Yeah.
It's fascinating. I can't tell you how many times it comes up. And whenever we have anybody from a college, it's like, why does it cost so much?
And they don't always have a great answer.
Yeah.
That's true.
Yeah. Good stuff. Jillian, thank you so much. Good luck with the book.
Thank you.
Jillian Berman, author, Market Watch Assistant Managing Editor, News and Enterprise. Her new book, Sunk Cost, Who's to Blame for the Nation's Broken Student Loan System and How to Fix It. How long have we been talking about this? A long time.
My entire career.
Unbelievable. All right, folks, you are listening and watching Bloomberg Business Week Daily. Carol Massar, Tim Stanovic, and this is Bloomberg.
It's 4:40 on Wall Street. I'm Amy Morris. United Airlines offered two profit scenarios. One reiterating previous guidance if the environment remains stable. The other predicting lower earnings if revenue gets worse. Shares of United Airlines up more than 6% now in the post-market. Stocks were volatile as President Trump's tariff war with trade partners showed no signs of abating, leaving investors risk-averse. We bring you those closing numbers each day here at Bloomberg. The S&P down 9 points, NASDAQ losing 8, and the Dow is down 156 points. 10-year Treasury yield at 4.33%, and the 2-year Treasury yield is at 3.84%. Hyundai expects car prices to remain relatively steady over the coming months, despite added costs from the escalating global trade war. Automakers are trying to maintain stability and keep customers coming back to their lots. President and CEO Jose Munoz on navigating President Trump's tariff rollout.
It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by tariffs.
Jose Munoz speaking with Bloomberg TV. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Carol Masser and Tim Stenevec.
Hey, thanks so much for that update, Amy. I do want to continue on a story that Amy mentioned. United Airlines shares up 7% right now. The company stood by its full-year profit outlook, but it warned a recessionary scenario would erode demand to dramatically lower earnings. As Amy mentioned, in an unusual move, the company offered two different profit scenarios.
It's like door number one, door number two.
Which one would you take?
Yeah,
hopefully the one
non-recessionary.
Exactly. Hey, for all things aviation, we turn to George Ferguson. He's Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence. He joins us from Bloomberg Intelligence headquarters in Princeton, New Jersey. George, Carol said in our simulcast she's trying to remember the last time that a company put out two different pieces of guidance such as this. They offered two scenarios. I'll be honest with you, I've never heard of this. I don't recall a company ever doing this. What's your response?
Yeah, I don't think I've seen it before either. United has been a little bit of less is more on the guidance anyways lately, right? So they just give us an EPS. Everyone else will guide us to things like, everyone else meaning other airlines will guide us to sort of cost per available seat mile growth and, and potential revenue levels and things like that. Even give us a sense for kind of where EPS is going. But United just gives EPS, and maybe because they only give that, they decided they had to give us two scenarios.
Well, it's even kind of
interesting.
Even kind of wilder, maybe, is that they do this, door number one, door number two, and the stock's up 7%. Is it just a negative sentiment? Or that's
like
been
you said,
out
though,
there.
It had gotten beat up this year.
Yeah.
And with Delta last week, I think everybody was scared.
So is that why we're seeing the rally here?
That's my take, right? So earnings look a little bit better than we expected. I think they did a nicer job on expenses. Most of the regions, the two most important regions, domestic and Atlantic, came in similar to Delta, kind of where we would have expected. And if you look at their EPS guide for 2Q, it looks to me like consensus has to come down a bit, not a lot, a bit. And it also looks like it'll come in underneath last year's EPS. So it's nothing that I think warrants sort of a 7% rally. But again, maybe people breathing a sigh of relief here.
And I do want to point out that Scott Kirby, the CEO of United, is going to be on surveillance on Bloomberg tomorrow at 8 a.m. Wall Street time. What would be the number one question you'd want to ask Mr. Kirby?
Well, look, I mean, I think his cost per available seat mile numbers came in really nice compared to Delta. I see a little bit of, knockout of maybe maintenance and other things, but I'd want to know if he can keep driving those cost per available seat mile down around, sort of zero growth. It wasn't zero growth, it was 30 basis points. Maybe that's a wonky question too, and so maybe the second question I'd ask him is, what's going to happen to fares?
Yeah, that's a good question. I was looking at some fares actually for a cross-country trip next week, and they were very, very inexpensive. Which brings me to
wow.
And that would be next week. Which brings me to my question about something that United said when it came to demand in its statement, George. Here's what they said. In response to the current demand environment, United is removing 4 percentage points of scheduled domestic capacity starting in the third quarter of 2025. They're also making prudent adjustments to the utilization rate of its fleet, including ongoing reductions in off-peak flying on lower demand days. Is that saying loud and clear demand is waning?
I think so. I also think very interesting is off-peak days, right? And so, look, back before the pandemic, when these were really business airlines, they would keep off-peak schedule, and they would use it as frequency, right? Their business customers would want more frequency in and out of cities, right? So that it would meet the business schedule. They've really pushed to more of a model of a leisure airline where they've reduced frequencies and increased load factors, right? They just fly less times a day or less days a week, but they fill the airplane more. And that's why you're seeing these 80+ load factors at a United and Delta. Back before the pandemic, they were 70s. So they still sound more like leisure competitors to me than business competitors.
Hey, one last question on United before we move on to Boeing. George, if it is full year earnings dropping to as little as $7 a share if revenue worsens throughout the rest of the year, if that's a scenario, are we living in a recession?
Yeah, yes, they indicated that. I mean, I guess to put that in context, they earned about $3.5 billion, profited $3.5 billion last year. That's saying, look, we could be around $2 billion-ish if we go through choppy waters. Yeah, it looks like a recession to me. Feels like the downside could be more than that as well, though.
Right, should we talk?
We'll ask about the scenario.
But that's still profit. That's still profit. So that's what they're still talking about profit.
Yeah.
That's what I mean, yeah.
Yeah. Hey, George, got a couple minutes left with you, so I want to hit on one of the big stories from earlier today. Bloomberg reporting that China had ordered its airlines not to take further Boeing jet deliveries, citing people familiar with the matter. Beijing has also requested that Chinese carriers halt any purchases of aircraft-related equipment and parts from U.S. companies. Is this a big arrow in the quiver of China when it comes to this trade war?
It's a big headline arrow. The Chinese really hadn't been ordering many airplanes from Boeing at all. There's about 240 orders on Boeing's books right now from Chinese airlines. That's against a backdrop of about 6,000. Only 16 of those orders have been placed this decade or since 2018. Which is really Boeing was already in the penalty box, but I think they did the courtesy of making it a headline now.
So is all the business going to Airbus, or is it going to Comac?
No, it's largely going to Airbus. So there was like 150 deliveries into China last year of narrow bodies out of Boeing and Airbus. Most of those were Airbus. Even Boeing has some deliveries going in of airplanes built but not previously delivered. Comac's delivering 10, 12, 15 a year. That'll continue to rise. The Chinese have to be a little bit careful here in a trade war, because first of all, the Comac airplanes, the engines are supplied by GE. They're LEAPs. They're built half in Europe and half in the U.S., but are under, they're CFM, which is a GE joint venture with Safran out of France. So that can get caught up in this tariff game. And look, right now, what I see out of Comac is they've delivered a bunch of airplanes into Chinese fleets. Like I said, maybe the 20s-ish, I think, last I looked. They're not getting the usability out of those airplanes as much as they're getting out of Airbus and Boeing's in the same fleets, right? We'll look at the big airlines, China Eastern, China Southern. They're not getting as much service out of those airplanes. I think they still don't have those airplanes totally wired in for the durability they need out of them, use them all the time. But they're coming, and they'll continue to make strides, and in time, they'll be a large part of Chinese fleets, but I think we're 5-6 years from that point.
Yeah, and just to clarify, Comac is the Chinese state-owned aerospace manufacturer, so they're creating this narrow-body competitor to Airbus and Boeing.
All right, good.
And a wide-body coming.
We got to run. Hey, George, thank you so much. George Ferguson, Senior Aerospace Defense and Airlines Analyst over at Bloomberg Intelligence, right there at BI headquarters in Princeton. Shares of United, folks, they're up 6.4%. We've seen American move up as well, up about 2.5%, and Delta a gain of about 3.9%. This is Bloomberg. This is After.
listening to Bloomberg Business Week Daily with Carol Masser and Tim Stenevec on Bloomberg Radio.
Can I just say I love when the goofy Tim comes out?
Hey, you know what? That's at 4:53. That's when that happens. And when Emily Griffeo is here.
Let's take a look at some stocks on the move today. Joining us is Bloomberg News cross-asset reporter Emily Griffeo. All right, let's start with B of A.
Okay.
Reported earnings, and they did. Investors liked what they got.
Yeah, big surprise. They got a record quarter because of their stock traders, because there's been a ton of market volatility. I honestly feel like I've been saying that over and over again.
Because you have been?
Yes, because of the big bank earnings season.
Well, this is the last day you can say that.
Right. But it's been a very common theme. Their net interest income also beat estimates. Bank of America is unique because they have a big kind of like read on the consumer because of their credit card business. The CFO said consumers have proven resilient. So there's a read into the macro.
I was waiting for this one.
He counts down to it. He's like, I can't wait till what B of A has to say.
Yeah, because they've got such a good view on the consumer. And
right.
We get here and it's like, wait a second, didn't we just hear concerns last week from Goldman about a recession, then pulling the recessionary call after the pause in tariffs, and the concern about consumers, the Friday consumer sentiment data that we got where it was like, okay, consumers are having high inflation expectations. From the banks, we got none of that concern.
I know, Brian Moynihan, our business clients have been performing well, and consumers have shown resilience, continuing to spend and maintaining healthy credit quality. Now this, I mean, it doesn't take into account like last week, all of the volatility,
That's a good point.
Would that have hurt
It's
people?
backward,
Maybe, it is backward looking in a way.
But still,
like
you would, it's not like he was overly cautious in terms of where we are right now.
Kat Doherty did make the point on our program earlier. She covers the bank, and she said a good portion, you could characterize, basically the way I characterized her comments were, it sounded like he was talking about the years that they spent getting the bank into a very good place, should there be some sort of crisis, and how they were more prepared now than they were, let's say 2008.
And perhaps in choosing their clients that they work with, right? So maybe more.
Yeah.
Whatever.
I would, whatever Kat Doherty says on Bank of America, I would listen.
All right, go to HPE. This
Packard
too
Enterprise
was a big gainer today.
Yeah, this was a big gainer, and some Bloomberg reporting about deal news. Elliott Investment Management is said to have built a large position worth more than $1.5 billion in the software company.
It's about a $19.7 billion market cap company, so that's pretty substantial.
That's pretty substantial, yeah. The investment makes Elliott one of the company's top 5 shareholders. The stock was up as much as 8.8%. It paired a little bit, but it still finished the day up 5%. It's down almost 30% year to date. But it seems like Wall Street likes Elliott taking this stake. You look at what Evercore ISI had to say. They said the stake is a positive for the stock, given Elliott's track record of activist management. There's still some other pending news when it comes to the DOJ and their lawsuit against HPE. But Evercore said, we believe that Elliott will be able to help drive additional shareholder focus regardless of the pending acquisition's outcome. That's a lot of words, but yes, the stock was higher today on this news.
Yeah, really, like mega outperformer. So we'll see. And we know Elliott, right, when they're playing in the tech space, they tend to do pretty well.
Yeah.
I think in terms of some of the changes that they push for. All right, get a name to the downside for us.
Okay, Albertsons, because I couldn't just come with all green, stocks green. I had to do a decliner. It was down 7.6%, biggest drop since October 2022. This is one of the largest grocery chains in the U.S. And it was interesting because their annual outlook excluded the impact of tariffs, which in a way, I guess, speaks to how businesses and CEOs are having difficulty keeping track of just the changes that are going on in tariff policy and the uncertainty. But executives for the retailer didn't explain why they made that decision. And they did say that they domestically source more than 90% of the products that they sell, which you would think would be a good sign. But yeah, overall, it seems like that tariff uncertainty and then also a fiscal year adjusted EPS that missed estimates was what was weighing.
Did I say
on
that?
the
Is
stock.
it the incoming CEO called it an investment
An investment year. Yes. CEO Susan Morris calling it an investment year.
Yeah.
This
maybe,
was,
maybe
yeah.
there's concerns like if you're investing. So maybe, I mean, margins in the grocery business are so slim.
Yeah.
Right. So maybe if you're investing, spending money, maybe your margins might be even more challenged.
Speaking of deals, Albertsons and Kroger have been in a big back and forth, and
That's still happening?
I don't want to misspeak on it. I haven't been following it that closely, but
that
it's
it
a
is.
super interesting story, at least just between like two businesses that they wanted to merge and they're no longer merging.
Listen.
And there's lawsuits.
You know that?
Really interesting story. I recommend people
All that matters is
read about it on the Bloomberg.
whatever ice cream is on sale is the ice cream I'm getting. That's all that matters.
Really? I feel like people are pretty brand loyal with ice cream. I know what I want.
No, like
Haagen-Dazs.
I'm pretty loyal.
Cookie dough.
Yeah.
It's
Really?
better than
So
the
you're
other
doing
cookie
Haagen-Dazs
dough,
cookie dough?
brands. Yeah.
Really?
Yeah.
Oh, okay. Elizabeth Sedgren says Ben & Jerry's Half Baked is her go-to.
Yeah, I mean, Ben & Jerry's
Amy
is very
Morris
good too.
says Americone Dream. I don't know why we didn't spend the whole time talking about this because this is all people care about.
Right.
Carol Master, what's your go-to?
It's the stuff that's actually not even ice cream. It's what is that one?
Okay,
they have a
never mind,
raspberry
pass.
and a coffee. No, they're really good.
Talenti.
Talenti.
that stuff is very
pretty
good.
I love
That is
Talenti.
good. Okay. I thought you were going to say some like coconut thing or something.
There's also Aretusa Farms.
Oh,
really
Sebastian.
good.
This is me too. Sebastian
Tillamook.
says Tillamook.
Tillamook.
That is my stuff. The double cream.
That's one mega.
I mean, it's also
Tillamook comes
Oh,
in a big.
Graders. How does
Right.
Elizabeth know
Hey,
about
kids,
Graders? That's Cincinnati.
Kids, we got to wrap this
Okay.
up.